Good morning, ladies and gentlemen. If everybody would kindly take their seats, then we will begin with the Annual Conference 2022. Thank you very much. Hello, good morning, and a very warm welcome to the Single Resolution Board Conference 2022. I'm Melinda Crane, and it is a pleasure to accompany you once again as moderator. And when I say pleasure, I really mean it, because what a joy that we can come together once again, not only on screen, but here live in this room. I have to say, amazingly, the SRB organization team did manage to keep this conference going over the last 3 years without hitting the pause button. We met virtually several times. It was not always entirely smooth, but we managed the turbulence. Nonetheless, I think all of those who are here in the room will undoubtedly agree that it means a lot to meet again here in person at this very key moment in time. And I would also like to extend a very warm welcome to our virtual audience who are with us here on the screen. I said it's a key moment, and that is, first of all, of course, because the challenges that we face, both the far-reaching implications of Russia's invasion of Ukraine, also the pandemic, which of course is still not entirely over, they are impacting economic and financial stability. Secondly, it's a key moment because the European banking sector stands at the threshold of two very important milestones. Firstly, the deadline for full resolvability, which is now just 15 months away. And secondly, the Single Resolution Fund's attainment of its target level, which is why this year's conference is entitled European Banks Resolvable and Ready for Crisis. And ladies and gentlemen, there is also a third reason why it's an important moment in time. Elke König, who has been at the helm of this organization since its inception, will be stepping down at the end of this year, which of course is a very important moment, both for the SRB and I think for all of those who have followed its activities. And I know that you won't want undue displays of emotion, dear Elke, so let me just say that I think I speak for everyone here when I say we will miss you. And before we begin with words of greeting from the chair, let me just give you a few hints about our format and procedure. We will be taking questions at the end of our panels, as we always do. We will open the microphones in the room and also hopefully fit in a couple of questions via Twitter. We'll have to see how much time is left. Twitter hashtag is SRB Resolution 2022. I think you see it up there, exactly. And on your screens, if you're following this virtually, you will also see more details about how you can submit your questions that way. Videos of the conference will be uploaded to the SRB website, and we'll also be producing a report. And our graphic recorder, Caroline Chapelle, who's been with us so often in the past, there she is over there, and you can see the wonderful drawing that she's already begun. She will be following the discussions with the audience and with the speakers, and will draw a visual record that you can look at as it develops over the course of the day. And finally, a hint to all of our speakers, if I may. As you know, our windows of time are always quite compact, so we're very grateful for concise answers, meaning about 3 minutes or less in length. Thank you so much. And ladies and gentlemen, we will also be streaming the speeches and discussions on the SRB website, meaning for our speakers, we are not on Chatham House rules. We are live, as it were. And now, let's get started. It's my pleasure to hand over to the SRB Chair, Elke König. You have the floor.
Thank you, Melinda, and good morning, and a very warm welcome from me to all of you here in Brussels and to those that listen us online. Unfortunately, our Vice Chair, Jan Reinder de Carpentier, was unable to join us today, so you have to bear with me for the introduction. I know it has been said many times these past few months, but I think it's really wonderful to see and to meet so many people in person again. This, as you know, will be, Melinda said it already, my last conference as chair of the SRB, and so I'm really delighted that we have some of the banking sector's top people here with us today, as well as high-level regulators. And we are not just Europeans, we are here from even beyond Europe. Today, we tackle, as Melinda has already said, the question, European banks, are they resolvable and ready for crisis? To be fair, I don't have a definitive answer to that question, but I do know that our speakers and panelists today will have plenty of comments, ideas and views on the state of our banking sector at present. Ladies and gentlemen, definitely a difficult winter is ahead of us, and at least yesterday you could get the feeling the winter has started, so let's hope that it's warming up again. There are many who say that dark clouds are gathering, not least due to the ongoing Russian invasion of Ukraine. How difficult the near future will be, no one knows, but the uncertainties are clear for everyone. But what we do know is that promoting financial stability by ensuring an even more robust, ever more robust banking system and also banking resolution system is of the essence in uncertain times. And this is something that we can help to control and manage in the interest of protecting depositors and the tax-paying public. When the big financial crisis hit in 2008, regulators had to introduce structural reforms to the European banking sector to make it more stable and efficient, because I think we were utterly unprepared for that crisis. The Liikanen report was published nearly 10 years ago, highlighting bank recovery and resolution as one of the key financial regulatory reforms. Time flies, but it's also fair to say that the banking union had a flying start thereafter, and I see Andrea sitting here who hopefully confirms. Today, we can tick off many of these recommendations. We have the banking union with two strong pillars for harmonized supervision and resolution. On top, we have established, Melinda mentioned it, the Single Resolution Fund, which is on track to reach its target level by the end of next year. It's simply true to say that we can't predict or even prevent any future crisis. But it is also true to say that we can take action to be well prepared. We can be ready for crisis by ensuring that the European banks are resolvable and that we at the SRB and the broader single resolution mechanism are ready to implement any relevant resolution scheme when needed, and let's hope it will not be needed too often. But are the banks all ready for crisis right now? Well, if asked in public, I would normally always say, of course, we will manage. But I think the fundamental question is really, are we ready? What is still missing? What needs to happen? Before looking at today's agenda, I would like to recall some recent developments in resolution at European level, and I will be very short. The resolution of Sberbank showed again that the system works. Financial stability was maintained. There was no need for public bailout. The taxpayers were protected. That is the definition of a successful outcome of a resolution case. And it is reassuring that we saw it now twice, Banco Popular and also Sberbank, that the system effectively works. Still, the SRB has been clear that future strengthening of the system is urgently needed. Let's be honest, the June Eurogroup outcome was not what we had all hoped for. But there's no point in looking at what we should have gotten. Let's focus on the progress made, as there was a lot. Looking at the crisis management, deposit insurance framework review, it's quite a mouthful. We support measures to enhance and support the framework, and we look forward indeed to the Commission's proposal, and maybe the Commission will have something to tell us later about this proposal in concrete terms. We can see that there is support for a wider use of the so-called public interest assessment to cover small and medium-sized banks, and for broadening the application of resolution tools in crisis management at European and national level. Importantly, and we've said that constantly, when we expand the scope of banks covered by resolution, we also need to think about and to make sure that there is an effective mechanism, including funding options for those resolutions that support the existing framework in the banking union and enable the market exit of failing banks. Let me stress, we talk about market exit, not about resurrection or long-time life support. After all, resolution is not a free lunch. It needs MREL to be in place, burden sharing by shareholders and creditors, and sufficient additional funding mechanisms if needed for an effective outcome. This, in turn, means we need a control mechanism at the European level for using any external funding. So my clear message is, let's make sure that we are not renationalizing. We need more, not less, Europe in our overall framework. And I'm pretty sure our speakers will have much more to say on these topics throughout the day. On the agenda now, and I hope you agree that we have a really top-shelf speakers on a range of interesting topics. In a moment, we will hear from Jens Henriksson, the CEO of Swedbank. I think it's most interesting to hear your views, not least also given the geographic location of Swedbank's operations. Later, we will hear the views from another part of Europe with a speech by the governor of Banque de France, François Villeroy de Galhau. I will not go into any detail of the panels. Melinda will introduce them later. For my part, I'm really looking forward to take part in a fireside chat just after lunch. And I'm sure that Nicolas will have quite challenging questions. Be mild with me, Nicolas. We'll see. Finally, before I conclude, let me say a special thanks to our media representatives here in the room. And the simple argument I would like to bring is, it's crucial that there is confidence in the public about what we do. And the ones that are sending that message to the public is the media. So we rely on you to communicate our messages to markets and to the people we serve and strive to protect. And that's, again, the European taxpayer. Your work is important in both peace times and, of course, in crisis times. More than ever, we are aware of the pressure you are all working under. So thank you for making the time. With that, I will conclude and will give the floor immediately to Jens Henriksson. Thank you again, and let's see what the discussion will bring. And the floor is yours.
Thank you, Dr. Koenig. Ladies and gentlemen, I am very honored for be given the opportunity to speak here at the Single Resolution Board Conference, even though I must admit that resolution is the last place you want to end up as the CEO of a bank. Let me therefore start on a sober note. I'm sorry to say that we banks do not produce goods, we do not grow food, we don't fly airplanes or serve drinks. We do not teach, cure or clean. We are not the purpose. You cannot eat money. But we empower people and businesses to grow and prosper. We are the enabler. We channel people's hard-earned money deposited at our banks to a couple's first flat, solar panels on the roof, and to a brand new battery factory. Rightly done, we are a part of building a financially sound and sustainable society. But sometimes we make mistakes. We lend out money to projects that goes bust. We fail with our internal control systems and get fines and lawsuits, and we are on the wrong side of a trade. That is why we have buffers to handle mistakes, because if we cannot handle mistakes, we get into trouble. And for bank, this is not only a problem for our shareholders, because when we get into trouble, it affects the whole society, because trouble at a bank means trouble for people and businesses. Credit channels get clogged. A firm can no longer get the money to finance a new energy-efficient machine. The oil burner in the house cannot be replaced by a heat pump. A couple cannot start a family in their own house. And this is only what happens when banks are too strict and conservative to deal with temporary problems. If banks starts failing, the whole economic system starts to unravel. And I've seen that with my own eyes in my different capacities at the Ministry of Finance in Sweden and at the board of IMF. I've seen it up close in Sweden, Iceland, Estonia, Latvia, and Lithuania. And the International Monetary Fund has shown that the financial crisis has long-lasting scars on society at large, with persistent unemployment, shorter life expectancy, and political turmoil and extremism. That is why we banks are not fully entrusted with deciding our own buffers. That is why we have Basel rules with a focus on capital buffers. Buffers that make sure that we can handle losses. But sometimes we tend to forget the most important buffer of them all: profitability. A sustainable bank is a profitable bank. Sustainable profits is the best way to avoid credit scarcity, and sustainable profits is the best way to avoid costly resolutions. Let me be direct. As the chair said, we live in difficult times with a pandemic, war, and energy crisis. Inflation is reaching levels that are way beyond what is good for society. Consequently, central banks are raising rates, both out of signaling reasons and to manage demand. And European banks have for a long time suffered under negative rates. Deposits have been costly and loan demand has been low. And when rates go up, net interest income starts to grow, and both are good. Interest rates should be positive, and European banks' income need to increase because profitability in the banks needs to go up. The Swedish outgoing governor of the Riksbank, Stefan Ingves, used to open conferences by saying, "Swedish banks are profitable. We should be glad for that." I agree with the governor, and I'm proud of the fact that Swedish banks are profitable. Profitable banks build capital. Sustainable profitability levels and the ability to build capital is the best vaccine against going into resolution. But in these times, politicians all around Europe are now thinking about bank taxes and extra levies. And I need you on the barricades. I need you as resolution managers to say loud and clear that we need profitable banks, to have buffers, to empower the economy, to let us be the very enablers that Europe needs in this perilous time. I have the privilege of being a CEO of a profitable bank. Last quarter, we posted a return of equity of 12%. But I promise to come back before year end with a plan on how we can reach 15% return of equity. And that is good for the bank, and that is good for our shareholder, and that is good for society. Thanks to our strong profitability, we've been there for our customers during the pandemic, advising them in turbulent time and providing liquidity. And during the lockdowns, we've been operational, kept branches open, and increased availability in our digital channels. And as a terrible war raged in Ukraine after the unprovoked Russian invasion, we have secured our operations, and we are vigilant and heighten our readiness and capability to withstand daily cyber attacks. We enforce sanctions while at the same time make it possible for refugees to function in a new country with a bank account as a first step. In turbulent times, we are needed to provide guidance, to make sure liquidity is available to overcome broken supply chains, or provide financing to invest in energy efficiency as prices soar. Banks are a part of the solution to tackle our long-term challenges of climate change, and this transformation requires investments. Investments that we make possible, and profitability is a prerequisite for us to do that today and tomorrow. Well, enough said on that. We still need resolution planning to plan for the worst. As a banker, I say that we must talk about this topic and prepare for it, even if we, of course, don't like it. It highlights the importance of our sector to society at large and the contribution we do to promote growth and prosperity. And the recent crisis has shown that we can be part of the solution and not the problem. Let us start with the financial side. The MREL is crucial, as this indicates that the bank's balance sheet can be written down and debt be converted to equity. In theory, the financial side is simple and intuitive, and it's fair and transparent. Investors know the risk and can choose where on the scale they want to invest. And the old framework, with authorities backstopping all the bonds, nationalizing, recapitalizing, and after a while taking it back to private, were honestly, in many cases, great successes. But they also meant that bondholders were shielded. MREL means that risky banks will need to pay a premium, which is good, and giving incentives for less unhealthy risk-taking is also good. But what happens when we see bondholders losing big money? Will there be political pressure from pension funds to get redeemed by taxpayer money? I was the executive director at IMF for Iceland when they decided to default on their bonds, and there were certainly hiccups there. And as a strong proponent for what we in Sweden, unsurprisingly, call the Swedish model for handling a banking crisis, I'm slowly being convinced that the present framework is the right way to go. But when it will be tested for real, there are certainly lessons to be learned. Having said that, we all know that the tricky part is the operational side of the resolution framework. At Swedbank, we have dedicated units and management attention on crisis management and resolvability, because the end point for a crisis large enough is resolution. We plan for it, but we strive to never use it. It's like a testament. You have it for those that are left. It provides assurances, and that's why we invest in resources to assess our resolvability, build scenarios, plans, and playbooks for various parts of the bank's operations. To be able to deliver our part of the resolution planning, we need your guidance and clear instructions. And the expectations from the authorities must be transparent, realistic, and clear. Cooperation and dialogue are keys to succeed in an efficient and realistic resolution planning, as the authorities are responsible for the plan and the strategy. And we must do our part to ensure that this plan is feasible. Therefore, we need to understand what the authorities plans for, we need to understand what you expect from us, and we welcome the EBA guidelines. They contribute to a more harmonized application across the EU, but there is still some way to go. In this regard, I also like to stress that it helps if authorities are generous on time and support cooperation between banks, since resolution planning is not a competition area. Together, we need to make sure that we allocate time for the development and implementation to meet the expectations. And during the process, we have noticed a few areas where we together could improve and bring clarity. Responsibility between the supervisory authorities and the resolution authorities is not crystal clear, as we move from recovery to resolution. Resolution authority makes a partly different interpretation of frameworks, which makes it complex for banks operating in several countries. And communications from bank and authorities must be synchronized to ensure timely, accurate and consistent information to the market during a resolution scenario. Let me end by going back to capital and the capital output floor, because wrongly implemented, it is questionable from a crisis prevention and management perspective. For Swedbank and other Nordic and German banks, the capital output floor may, if implemented the wrong way, increase the capital need for those clients with the lowest risk. And that's counterproductive to what we want to achieve. The European Commission has tried to mitigate that in the new banking package, and it's time for the member states and parliament to embrace that. The pandemic tested the Basel capital buffer framework for the first time, and it indicated that the interaction between the prudential capital buffer framework and MREL might need to be revisited. It showed that the capital buffer usability during a crisis can be very limited because we banks did not dare to use the capital to lend. And it showed that supervisors and resolution authorities needed to find the right balance between dynamic buffer requirements and the post-resolution capitalization levels that MREL should achieve. So let me conclude. A prerequisite for banks to be resolvable is clear and transparent requirements and guidance from you so that we know our destination. Because the difficult part is not to walk, but to decide which direction to take when the destination is unknown. Once we have a plan, we need to test it, evaluate it, and adopt it on a regular basis. And that's how we improve it. That's how we ensure that we have feasible crisis planning. But as the military saying goes, every plan is a good plan until the first shot is fired. And I'm not convinced that our 500-page plan today will be much better if you will make us write it twice as long. Why not force us to write the plan on one page? 12 times New Roman, so you don't get the wrong font, otherwise you'll probably squeeze it in. So we CEOs can have a laminated version in our inner pocket. In the end, this is not a bureaucratic exercise. In the end, this is practical work in a stressed time. I've experienced firsthand how financial crises tend to start with one institution and then spread. Resolution planning is one tool to reduce the impact, but swiftness to act will be of essence to contain it. Strong public finances are needed to maintain trust, and prepared authorities with a clear mandate and ability to cooperate are needed to execute. We don't know what the next crisis will look like, but we know that it will come. Profitable banks will weather it and continue to empower people and businesses to a financially sound and sustainable society, because that is what it's all about. Thank you. And thank you all for your hard work in contributing to a well-functioning EU financial system. Thank you.
Many thanks, Jens Henriksson. And exactly, you can actually, maybe you want to, right, exactly. Your place is there, second one from the end, because of course you will now join our first panel. And I would also like to ask the other members in the panel to please join us on stage, and then I will do our introductions. So welcome to all of our speakers. And I have to say, while you were speaking about the idea of reducing the plan to one page, I was looking at what our graphic artist achieves on one whiteboard and thinking that she might be just the right person to try to tackle that 500 pages down to one. It is now my great pleasure to introduce our panel members, and I'm going to keep the introduction short in the interest of time and ask you, dear ladies and gentlemen, to please consult our website if you'd like to know more about our panelists' very impressive vidas. So it is a great pleasure to welcome once again Sean Berrigan. So glad that you can be with us once more. He is Director General of Financial Stability, Financial Services and Capital Markets Union at the European Commission's DG FISMA. Welcome. And also with us once again, another returning and very welcome guest, Andrea Enria, is chair of the SRB's sister, the Single Supervisory Mechanism comprising the European Central Bank and national supervisory authorities, and he previously served as chair of the European Banking Authority, the EBA. Welcome. Seated next to him is Megan Green. She is Senior Fellow at Brown University's Watson Institute for International and Public Affairs and also Chief Economist at the international advisory firm Kroll. Welcome, Megan. Great to have you with us. And there on the outside of the panel is Sebastiano Laviola. He is member of the board of the Single Resolution Board, and it's great to see you again, Sebastiano. Welcome. And, of course, Jens Henriksson with us from Swedbank. So, ladies and gentlemen, we will take audience questions at the end of our discussion. We will open the mics here in the room and also hopefully squeeze in a few questions via Twitter. The title of this first panel picks up essentially on what we heard from Elke König earlier. We are in testing times and therefore want to talk about building up crisis management. And if you were with us last year, you'll remember that at our conference in October 2021, there was widespread agreement that the euro area banking system had come through the pandemic with pretty remarkable resilience. But of course, that was prior to the cascade of crises that we face now this year, some of them precipitated by Russia's invasion of Ukraine and others, of course, pre-existing, but exacerbated by the conflict. Soaring inflation, sharp spikes in energy prices, ongoing supply chain disruptions, all of them are creating rising uncertainty, and of course we are seeing forecasts for growth being downgraded, which makes it more important than ever to ensure that a robust financial system, and this was certainly Jens Henriksson's point, can support the real economy. You told us when banks are in trouble, then there's going to be trouble in the real economy as well. And recognizing that, the Euro group of EU finance ministers recommended in June that the strengthening of the common framework for bank crisis management and deposit insurance schemes is important, and that is our focus now. So I'd like to ask all of you to please get us started by sharing your assessment of the banking sector's health now and in the near future. On the one hand, of course, profitability is likely to rise in a scenario of higher interest rates that we heard from Jens Henriksson. On the other hand, the challenges that I mentioned pose obvious risks to the real economy. So is it now more urgent than ever to complete the crisis management framework? That is our opening question, and I will go straight down the panel, beginning with Jens Henriksson.
Well, I think you've heard enough of me, but of course, tough times are approaching. And it was a summer of illusion, an autumn of despair. But the good thing is that interest rates are going up, and that means that the profitability for the banking sector goes up. When it comes to review, I would say let's implement what we have. But then on medium-sized banks, well, then we could probably look a bit more.
Thank you very much. And straight to Sean Berrigan, please.
Thank you very much. Well, yes, Elke, I believe, was talking about testing times. We have testing times ahead of us. We've had testing times for quite a number of years, actually, if I'm honest, just different types of tests. And this time it's going to be one a combination of rising inflation and decelerating growth. So this is a particularly difficult combination for macroeconomic policymakers, but I'm no longer a macroeconomic policymaker, so I can leave that to them. I can also leave the health of the banking system to Andrea, because he knows a lot more about it than I do. So I just wanted to focus on this last point you raised about whether it's more important now because of these tests. Of course, given a weaker economic environment, the probability of stress in the banking system goes up. But as we know, the banking system is pretty resilient. It has been made resilient since the reforms we put in place in 2010. And I'll anticipate Andrea a little bit by saying I hope the banking system is pretty robust going into this testing period. For that reason, I don't think it's any more urgent to do it now than it was. I mean, this framework was constructed not for a particular macroeconomic environment. It was constructed to handle an idiosyncratic shock in the banking system, which can, of course, come through economics, but can come through other ways as well. We see Sberbank, which was not necessarily a macroeconomic shock. So there are many ways in which banks can get into trouble. So I think, irrespective of the economic environment, we need to work on the crisis management framework because it's there to handle a particular problem, and that problem can arise whether the economy is doing well or the economy is not doing well. So I think if I go back 5 years ago, I would have been just as interested in reforming this framework. Reforming is a strong word, improving the framework as I am now. Thanks.
Thank you very much. Over to Andrea Enria.
Thank you. Well, let me start by sharing Sean's assessment. I mean, the review of the CMDI package is not an urgent reform to address an immediate concern. I mean, it's a structural step forward towards the completion of the banking union. And to be honest, knowing the timelines of legislative packages in Europe, I hope that by the time this is over, if we're going through a recession in the near future, we'll be out of the woods. As to the banking sector's health, indeed, we have a very strong starting point. I mean, the banking sector in Europe is at its highest levels in terms of capital adequacy, you know, also notwithstanding, let's say, quite significant distributions in the first part of the year. Asset quality has been improving throughout the pandemic, is still improving. The first half results were very, very strong for most banks. So I think that the starting point is good. Of course, this is looking at the rear view mirror. Now the point is what is going to happen ahead of us. And banks, I think, remain pretty upbeat, exactly because they think that the main drivers of potential downsides for them, so the deterioration of asset quality, the downward revaluation of securities portfolios, and the increase in the funding costs are in the baseline going to be more than compensated by the positive effects that interest rates are going to have on the net interest income. And we tested these also against a sort of textbook 200 basis points shock on interest rates, and the result still stands. But there are some downsides, definitely. We have seen the ECB staff projections a couple of weeks ago, and in a scenario of rationing of energy, of gas, of course, we are going to face a recessionary scenario, and this is going to be a significant challenge to this baseline. And furthermore, I would like to say that, it's not just the average that matters. No, it's also the distribution across banks. So we are pushing banks to focus very much on their concentration of exposures towards sectors which are particularly dependent on energy and fragile to energy shocks, so especially in the manufacturing sector, sectors or counterparts which are particularly exposed in case of interest rate increases, so commercial real estate, residential real estate, consumer finance. And then there is also the issue of, exposures to energy derivatives clearing that we have seen as an issue in the recent times, and also exposures more generally to energy providers and energy trading companies. So we are asking banks to review their capital projections under severe adverse scenarios, and we will engage in a dialogue with them. But let me also say, and I will close here, that we should be rather wary of our ability to predict the future. We as central banks or supervisors, but also the banks. I mean, models are the best thing we have to predict where things will go, but, models can also are just taking the past and factoring it into the future. No? And if you look at the past, for instance, if you take internal models of banks, they are based on 2.5 years of the lowest level of defaults in the industry. So the risk of having a little bit of an excessively benign expectations on the future is there, I think. Thank you.
Thank you very much. And let me go over to Megan Green also for an outside look at the health of the European banking sector. How sanguine are you not only about the situation today, but also what's ahead?
Yeah, thanks. I'm going to give you a classic two-handed economist answer to some degree. I would say European banks came through the pandemic much better than some of us had feared. And while negative rates have been a challenge for European banks, the tiering has really helped them. I would also highlight that the targeted longer-term refinancing operations, or TLTROs, are incredibly generous now. They were already generous, whereby banks were getting subsidies, basically, if they didn't shrink their loan books. Now that rates are rising, though, because the actual TLTRO rate is calculated based on a 3-year average, they're incredibly generous. And so, according to Morgan Stanley, Eurozone banks could gain 24 billion in extra profits by the time the TLTRO scheme is wound down by the end of 2024. So that's going to help banks a lot as well. That being said, everyone has highlighted that winter is coming and that the challenges will increase from here. And so Eurozone banks do face growing asset quality concerns. And so, a classic bet on growth is to bet on the banks. The Eurozone looks much closer to recession than, for example, the United States does. And so if that's the case, we're seeing that stock prices for Eurozone banks are already depressed relative to book value. That will just get worse. And so I do think now is a good time. Internationally speaking, we all kind of lost sight of banking union over the course of the pandemic. On the international stage, the conversation fell fairly quiet. But now that the pandemic seems more endemic, that Italy's come back into the spotlights, I do think that the conversation is starting back up again. So I'm glad there are lots of people in this building right now, in particular, thinking about it. I think now is the time to go ahead and strengthen some of the architecture.
Thank you very much. Of course, on this stage, or at least on the stage on which we conducted the annual conference for the last few years, it certainly never did fall quiet. It is obviously an ongoing challenge. Let me go now to Sebastiano for the same question, and then we'll drill deeper.
Thank you, Melinda. And I would say that I share, by and large, the views of the previous colleagues, that's to say that the banking system starts from a solid ground of improvements in the various areas. However, the outlook has, of course, dramatically changed. Therefore, close monitoring is necessary. Now, as regards the work done until now, of course, as you can understand, our focus is on resolvability, which is one of the themes of this year's agenda. And then let me share with you what we have assessed as progress of banks on resolvability in the recent past. You know that we have issued some guidance to the banks a couple of years ago, and then we have taken a first snapshot in last July, where we have seen how banks have progressed, at least on the profiles of resolvability, which were the first ones to be put in place. From this point of view, I have to say that we assessed a quite good progress, particularly on the most important resolvability profiles that we prioritize, particularly the loss absorption and recapitalization capacity, that's to say the MREL in our jargon, where all banks made progress. To give you a couple of numbers, I mean, we now have about 37 billion in March 22 shortfall with respect to the target of January 24. But this shortfall has decreased almost by 50% with respect to 2 years before, to end of 19. So this means that there has been a substantial progress. And also on subordinated component of that. Other areas are other elements of resolvability which concerns particularly the access of banks to financial market infrastructures and operational continuity in case of resolution, as well as improvement in communication and governance. Here the progress is wide-based. However, the G-size, I have to say, show relatively more advancement with respect to the other banks, particularly in MREL, where they have essentially no shortfalls with respect to the final target. However, there are other profiles that we are closely monitoring until the end of 23, because this is a transition period, and to have, in principle, banks that are fully resolvable. And this concerns the capability to estimate and then put sufficient mobilization of collateral for liquidity, so in resolution and post-resolution. This concerns the possibility of the management information system to deliver at short notice the required information for the valuation and for bail-in. And this concerns the capacity of the banks after a resolution to be able to conduct a good restructuring and also to separate certain assets from the previous estate. So this is what is expected to be done by the banks to complete all the profiles between now and the end of next year. And the focus of the communication from our side to the CEOs of the bank will be particularly based on this. I have to say that the assessment of resolvability is also a dynamic process. That's to say that the business model change and the economic outlook changes, as it has been said also this morning. So the work continues in terms of making able resolution plans to deliver a picture of full resolvability, we hope, by the end of next year. And from this point of view, the reform of the CMDI, being a structural measure, as Andrea recalled, I think would be needed because, to be clear, we had a framework that works today and was also used in recent cases. However, in order to fully complete the framework, we would need essentially that such a framework puts more focus on resolution, and whatever the strategy, resolution on liquidation facilitates market exit, including the use of private funding in more efficient way, that's to say the Single Resolution Fund and the DGS funding, without economic disruptions and without using public money. Thank you very much.
Thank you very much. And I'd like to now take us on a deeper dive on the 4 elements that the chair mentioned in her remarks earlier. They are the 4 elements that the Eurogroup agreed as necessary to underpin a stronger CMDI framework. And I'll just remind everybody what those elements are: broadened application of resolution tools in crisis management, further harmonization of the use of national deposit guarantee funds, the harmonization of certain features of bank insolvency laws, and a clarified and harmonized public interest assessment. And Sean Berrigan, if I can start with you, the Eurogroup did invite the Commission to bring forward proposals for a reformed framework with an eye to completing legislative work by early 2024. So my question would be whether you could give us a sense of the main reforms that the Commission does plan to include in the proposals and whether you see that deadline as likely to be met.
Thanks, Melinda. Well, yeah, I mean, in short, I think the way to look at this is to say that we introduced this new CMDI framework in 2014 to 2016, pretty much, but we didn't solve one old problem, and the old problem was how to handle these mid-sized banks. So we've always known how to handle the big ones. We used to bail them out, now we bail them in. And the little ones, we get into judicial liquidation processes, we're all very happy. These mid-sized banks were always a problem, and unfortunately they have remained a bit of a problem in the sense that they are not too big to fail, but they are too big to liquidate. And so essentially what we need to do here is to extend, as Sebastiano was saying, to extend the resolution frame to a wider set of banks. But of course, the resolution framework was essentially built for GSIBs. So one has to ask the question whether you can simply take that framework and apply it to these mid-sized banks, or whether you need to think about the actual structure and whether it needs to be different somewhat. Remain effective, but be perhaps more proportionate in some elements. And that is sort of the background to what we will do. In a sense, what we're trying to do here is to take the principles that underlie the system in the United States and apply it, translate it into a European framework. It will not go one-to-one, but we will take those principles and apply them. So as Elke has mentioned, and as the Eurogroup mentioned, there were sort of 4 areas of reform, but there's a kind of a key link which I want to mention as well. So when you look at this reform as it's presented, the idea is to extend resolution to this wider set of banks, and a lot of that will be done through the public interest assessment, and the SRB is already, to be honest, doing some of that before we even start. If you want to extend resolution effectively to a wider set of banks, you have to make sure that the funding arrangements for those banks are adequate. And we know that there's a sort of threshold of 8% bail-in that you need to pass in order to access the Single Resolution Fund. So this creates a kink in this line that I said of kind of continuous outcomes involving resolution. So we have to think a little bit around that proportionate element and around the arrangements for funding. These banks in the mid-size, if they cannot access 8% MREL, they cannot build 8% MREL, will not be able to access the Single Resolution Fund. So we have to think of other ways in which we can provide external funding for them. And that is where the DGS comes in as the third part of the reform. And that is, you have to think, if you want to improve the funding arrangements, what role DGS can play in those funding arrangements. And there the issue is different across member states. Some have already administrative possibilities for using DGS. Others uniquely use the DGS for a paybox function. So this is the harmonization that Elke mentioned, whether we need to think of moving across Europe to an administrative approach to DGS, allowing DGS to be used more flexibly, let's say, in any resolution stroke liquidation process. And that, of course, raises an important issue about the position of DGS in the creditor hierarchy, because the way we have structured our DGS directive is important, because this is the 5th point I wanted to mention, and that is the least cost test. Because the key to all of this is that it must be cheaper to use the DGS in a non-paybox function than it is to use it in a paybox function. And the way we have constructed the legislation today, in fact, and because of the super preference of DGS, that's always 0. So it effectively means the least cost test excludes a wider use. So we simply have to talk about super preference. It's a very technical discussion. It's also a very political discussion. But this is one of the issues we have to talk about. So I really see sort of four elements in the reform, but this least cost test being the kind of key kind of fulcrum around which the other parts will be organized. Now, in terms of can we deliver on time, well, people on this table, I'm just looking, certainly Andrea, probably those of us in the public sector, we're paid to be pessimistic. So, but on this one, I am more optimistic. The CMDI, as I said, is a very technical file. You know, it's going to be a very technical, deep dive file, but it is no more technical than, and no more political either, than the Basel III package or the Solvency II or the AML package. So it's just another day in the office in DG FISMA, if I'm quite honest. We will put it on the table, we will marshal it through, and I think on that basis we will make it to the deadline that we've set ourselves and have it done in this mandate. Thanks.
Thank you very much, Sean Berrigan. And Sean did outline a number of very key issues, and I want to try to keep them a little bit separate. So I'm going to ask us to reserve the DGS and least cost issues for a little bit later in the discussion, and first address some of the earlier points that he made. And I will go to Andrea and Ria, and definitely please speak to Sean's idea that the framework must be extended to mid-sized banks. That is also something we want to pick up on after lunch in our final panel today, but I'd like to get your point of view on that. And then also the criticism that we've hear from time to time that's been ongoing, that banking union has not delivered on truly European banks, and whether you think that the review of the CMDI framework will help to address some of the hurdles there.
Thank you. Let me say, first of all, that I thought I was optimistic, because if Sean completes his tasks in 2024, then you have the national implementation. It means that we would be out of the wood before mid-2025, which I hope indeed we will. Anyway, no, on the integration aspect, let's say, first of all, we have to acknowledge that there are areas in which there has been progress. If you look at the integration of wholesale banking business, capital market activities, asset management, custody business, leasing. I mean, you have seen a lot of also cross-border deals in the recent years. And now both European banks and the banks which start relocating business to the euro area post-Brexit have a quite integrated way of providing their services, either through branches or from a single center at the European level. The real area where we are stuck is retail business. There, it is true that the banking union has not really moved the dial since it started. And I think that this is exactly because of the concerns that are there at the national level on what would happen in case of a crisis, who would eventually foot the bill, and the issue of the safety net. So the CMDI, I think, can contribute to this process in a number of ways. Sean mentioned, and let me say that I agree with every word he said, Sean mentioned the need to take also some input, and inspire ourselves with the experience in the US. If you look at the US, where almost all banking crises have been dealt with also through mid-sized and even smaller banks through purchase and assumption transactions. In that case, let's say, I think that there are two important elements. The first one is that they've been able to ensure a smooth exit of a large number of banks in a very compressed period of time. We didn't in the past crisis, which meant that we left a lot of excess capacity in the system. And second, this process was managed very much at a US-wide level. So if there was a crisis hitting one state and the banks were going underwater in that state because of residential real estate markets problems or the like, eventually the FDIC enabled, through this purchase and assumption process, buyers from other states to buy the assets and liabilities of these banks. And this tightened the integration. The reorganization of the banking sector was countrywide, while in our jurisdiction, if you look also to cases where we used European money, the EFSF programs, all the reorganization, the concentration has happened at the national level. And this is a poor legacy. And finally, I would say that the major contribution could come because now I think that we are experiencing the debate on finalizing the banking union, an issue of trust amongst member states. And this issue of trust is based, on my view, on two stumbling blocks. The first one is that member states see that the common principles are applied in different ways, in terms of deployment of taxpayers' money or in different member states, as this is denting the trust they have amongst each other. And second, they have the concern that if you take all the covered deposits in the banking union, for instance, we would have more than 7 trillion, I think, covered deposits. So they are concerned they would be sign up to a joint and several guarantee for a very huge amount. Deploying a system, US-style system, should first of all harmonize and address the first concern. And second, if you look at the US, they dealt with 450 purchase and assumption transactions after the crisis. They paid, if I remember well, $68 billion on a least cost basis, so less they would have paid if they had reimbursed the insured depositors. and there was not a single dollar of taxpayers' money that was deployed because it was actually paid by the fees of the banks, and there was no need to activate the. So I think that moving to that direction could address some of the trust issues which are amongst member states and enable us to complete the banking union faster.
Thank you very much. So let's cross the Atlantic, because we've heard a couple of tributes to lessons learned on the other side of the Atlantic, Megan Green. And maybe you can talk a little bit both about what you think are the key priorities when it comes to harmonizing national bank insolvency laws so that, in fact, there is consistency with the European CMDI framework, and then also the question of how banking insolvency proceedings can be amended to ensure that smooth exit that has just been mentioned.
Yeah, I was going to say I was thrilled everyone else was talking about lessons that could be learned from the U.S., because if I say it with my accent, it just sounds like American, superiority. Exactly. But I do think there are a lot of lessons that can be learned, and of course, the FDIC was established in 1934, so it's been around for a lot longer than the resolution regime and the Single Resolution Board in Europe. Specifically on national bank resolution schemes, I think there's a huge problem of harmonization. So these schemes all differ in terms of the triggers for resolution or liquidation, as it usually ends up being. There are differences in the hierarchy of creditors, particularly around unsecured deposits. And then there are also differences in the availability of tools to manage it. And part of that is linked to, the fiscal space of each member state. And so I think, these three things really need to be harmonized. The triggers to initiate liquidation in some member states involve a bank being balance sheet bankrupt. And so that means that often you end up trying to figure out how to resolve a bank, and you have forbearance up until the point that you can acknowledge that it needs to be liquidated. That just means that the write-downs have to be bigger, ultimately. And it also kind of reduces competition in the banking system broadly. And so I think that's an issue and needs to be addressed. The difference in the hierarchy of deposits and also in the tools make it really hard to carry out assessments across borders. So you highlighted that one of the points of banking union was supposed to be to encourage cross-border banking. In Europe, we've actually seen the opposite of that, and I think this is one of the reasons why. So all of these things really need to be harmonized. What can we do about improving insolvency regimes? I go back to the answers I just gave. I think that would all help, particularly in terms of the triggers. But I also think the public interest assessment is problematic. There is a phrase you've probably all heard that European banks are European in life but national in death. And that seems to be the case right now. And given that that's the case, there is a general assumption that there will be public finance put into the banks as they are resolved or wound down. And as long as that's the case, there isn't a whole lot of market discipline. And so I think that if we could go ahead and shift the assumption from having a national liquidation scheme instead of a European resolution, that would improve market discipline, and that could help accelerate bank wind downs when they're necessary. So I think that would be useful as well.
Thank you very much. And let me go now to a bank that is partially a cross-border bank. Jens Henriksen Swedbank is, of course, a cross-border bank group within the EU, but also you have the largest share of your business outside the Eurozone, namely in Sweden. So maybe you can talk a little bit about what challenges that poses for you in a resolution context.
Well, of course, there are always some national differences in rules and setups and things like that. But you can live with that. Of course, you want to move in that direction. I would say the key part is a good cooperation between our resolution firm or board is the Swedish National Debt Office and the Single Resolution Board. And that is a very good cooperation. I just talked to them and they say that it's a good cooperation on that side. That's
Thank you very much. You've been so economical with your time that I would just like to ask you, if I could, to tell us a little bit more, because you mentioned earlier the great importance of collaboration and good communication between different actors. Can you just talk about positive lessons learned in your experience in that area?
Well, it's complicated in the sense that we have a national debt office here that's 10 people working with this. Because it's hopefully won't happen anything. And then you look on the Single Resolution Board with a few hundred. And of course, how do you find the balance between those two? And also, I think sometimes the Swedish way of dealing it with having more sort of focused on the core principles rather than EU, which is sometimes going very much into details. Finding that balance is very difficult. And I'm still referring back to my proposal I gave in the speech. We should be forced to have it on one page, because in the end of the day, this is an exercise when a lot of the sort of interesting part happens when you prepare it, but then when you're really at the stage we're going to use it, then it's one page, then it's fast moving, and if you can explain, you need to explain both to the general audience at large and the decision makers in very simple terms. How does this really help society? How do we make sure that the taxpayers don't foot the bill? How do we make sure that at the end it's creating a good and sustainable society, which is really the remit of the Systemic Risk Board? Or not Systemic Risk Board and the Single Resolution Board, of course.
Thank you very much. Then let's go straight over to Sebastiano to talk a little bit about the public interest assessment. It seems that the Eurogroup expects most of the banks under the SRB remit to be resolved when they fail. So I'd like to ask you to please talk a little bit how you see the PIA linked to the question of resolvability.
Thank you. Well, let me first start saying that the PIA is a crucial, key safeguard in order to safeguard the taxpayers and financial stability. And how it is used today, just for everybody to be on good grounds. Well, when the bank is about to fail, we assess whether resolution is in the interest of the public interest, or instead the bank has to go to liquidation and therefore normal insolvency. And we use the objectives that are in the legislation. That's to say protection of deposits, safeguarding financial stability, safeguarding critical functions, minimizing the use of public funds. Having said that, how we use PIA today and how the SRB, let me tell you, in the last 2 to 3 years improved the use of the PIA in the direction that is now welcomed by the Eurogroup. First of all, we run the PIA twice, in ex-ante planning and at the point of failure. Why? Because it was spoken about resolution planning. The plan has to be virtually the best one that can be ready for use. And therefore, the PIA, being a crucial tool to decide the strategy, has to be as encompassing as possible. In a nutshell, if you conclude that the PIA is negative and then at point of failure you turn it into a positive one, well, then you have problems in terms of resolvability, because the work that was supposed to be done has not been done. That's why we need a comprehensive PIA. Having said that, at the point of failure, this is run again. Why? Because conditions change, because the business model of the banks change, and because the economic outlook, as it has just been said, changes. And therefore, we have also to keep the flexibility in this regard. So how PIA is linked to resolvability and how a major push regarding more resolution may help. Well, first of all, in our work in the last 2 years, as I said, we have introduced some amendments to our policy in order to be more aligned with the legislation. That's to say that we have asked to our resolution experts to cater for the case where the bank not only fails under an idiosyncratic crisis, but also because of broader financial stability events, so a macro shock. And as a result of that, of this more complex methodology, there has been a change of some banks from liquidation to resolution. So today, I can say that in terms of risk-weighted asset, all the banks under SRB remit, 97% of the risk-weighted assets are banks earmarked for resolution, and 3% are earmarked for liquidation. It is about 18, 20 banks, but these are very special banks. They are public promotional banks or banks with a specific business model. Then we have made some further announcement. I will spare you with the other details in order to improve the methodology. Now, how the greater resolve of the Eurogroup, if taken on in the legislation, may help. Where I see improvements. Improvement I see essentially in a better harmonization also as concerns the same tool used for less significant institutions by the national authorities, and better transparency. Because, for example, when we introduced our amendments, our announcement, we pushed for the national authorities also to introduce them, and I believe that if in the end we have similarity of outcomes, notwithstanding different methodologies, but similarity of outcomes between LSIs and SIs, so banks with similar business size and similar business model, this certainly adds to the integrated market. And therefore, this could be a goal of the legislation, and probably a better transparency of the criteria used by everybody. Our criteria are already fully available, and we try to be as transparent as possible, and I think we will further increase down the road. But nevertheless, this is a welcome move. A final move that I think is in the interest of everybody, but particularly also of the SRB, is the legislation to clarify the access to data. That's to say that we have an important power under the Single Resolution Mechanism regulation to access data, but of course we want to limit the burden for intermediaries. So when the data are already available at sister organizations, in this case the central banks, not the SSM part of the ECB, but the monetary and financial part, the economic part of the ECB or other central banks, it is important that for justified reasons, these data are used and are easily available because, this is important to underpin the fundamental analytics of the PIA. Thank you.
Thank you very much. Let us now do one quick concluding round of questions, and then I'd like to come to audience questions as well. So I'd like to begin, if I may, Sean Berrigan, please feel free to react to what we've heard here, but beyond that, I'd like to ask you about another point of which the Eurogroup took note in its statement in June, namely of the Commission's intention to finalize review of the state aid framework in order to ensure consistency there as well with the CMDI. And if you could tell us what the Commission is planning there and when.
Well, thanks, Melinda. I have to be really careful here because I'm talking out of my shop, but I will talk out of my shop. I think what the Eurogroup recognizes that there is a complementarity between the crisis management framework and the state aid framework. The two fundamental principles of the crisis management framework is that you maintain financial stability and you protect taxpayers. I think to the extent that we can do that in every case, it means that no public money will be needed, and therefore, in a sense, the state aid framework becomes, if not totally irrelevant, a lot less relevant. But of course, what we're talking about here today is the fact that in not all cases are these two principles of financial stability and protecting taxpayers always aligned. And at least when it comes to resolution or liquidation activities that involve bailing in depositors in particular, some member states, in fact, those member states who've had to do it, in fact, have found that these two principles are not always aligned, that you cannot maintain financial stability while protecting taxpayers if that means you're bailing in depositors. And that's all what we're talking about here, and it's why I stress every time that if you want to extend resolution, you really have to make sure that the arrangements for funding are adequate. Now, what we have said, what Olivier Garçon has said to the Eurogroup is that we will, of course, review the guidelines. We are reviewing the guidelines now. But whatever comes out of that review must be somehow consistent with what comes out of the review of the crisis management framework. So if we get it right, and I think, if I'm honest, and we'll come back to that when we discuss EDIS, we're going to get it right, but we'll still be a few percent short, in my opinion. But if we get the review right, then I think the need for public money going forward will be much less, and then it will be much easier to have a state aid framework which is less called upon, let's say, in these situations. But I want to stress that you cannot review the state aid framework in advance before you know what the outcome of the crisis management review will be, and that's why our wording has always been very careful. We will do them in parallel and finish them together.
Thank you very much. Then let's now stay with EDIS, and I'll go to Andrea Enria. And in fact, ministers' inability to agree on building this missing pillar does perpetuate fragmentation. It's something we discuss here basically every year. And I'd like to ask you, from a supervisory point of view, what can be done to reduce or mitigate fragmentation, and also at the same time listen to the concerns of host states, and what banks can do in this regard within the existing situation that we have?
Yeah, I think that we should keep our eyes on the final prize of the completion of the banking union of EDIS, but I also agree that there is quite a long way that we could go within the current framework. I mean, what we have done so far has been to try to create space in three areas. No? I mean, the first area is M&As. I mean, when a few years ago there was an expectation in the market that the ECB would have taken a negative stance towards M&As, we clarified that this was not the case, and we clarified that this was not the case both for domestic and for cross-border mergers within the banking union. What has happened is that there has been an increase in M&A transactions, but they have remained predominantly domestic in nature. The second area in which we have tried to create space is that, of course, the legislation doesn't leave a lot of room for management of capital and liquidity on a group-wide basis. So there is a clear diversity between what you can do within a member state and across member states, even within the banking union. And this is the whole debate on waivers. No? So we have maintained also a pretty strict interpretation of the waivers, but recently I mentioned in a proposal I made with Eduard Fernandez-Bollo that maybe we can work as ECB on recovery plans, incorporating guarantees, intra-group guarantees in recovery plans, and being the ECB neither a home or a host authority, being an authority responsible for both the group and each subsidiary, we can ensure that these guarantees are enforced in a proper way, guaranteeing both sides of the interests. And third, let's say, I noticed recently that banks relocating to the European Union after Brexit are using much more the European tools, using the European Company Statute and merging all the subsidiaries in the banking union and creating a sort of, and branching out, and so providing really much more integrated services in the union. So what we said is we would be open to support more, let's say, reliance on branches. If you have branches, of course, it would be the home deposit guarantee scheme that would be on the hook, and therefore there wouldn't be this concern that if things go wrong, the local DGS has to foot the bill. Now, as you can see, not much has happened in these three areas so far. My point is that, again, if there are concerns of national authorities, we can deal with these concerns within the SSM. We are on the same side of the deal. National authorities, ECB, in joint supervisory teams can identify tailored solutions for each group that in each of these three areas can be reassuring to everybody. And however, let's say we need also the industry to take more ownership. So this space is available, and they need to develop their own strategy to see the banking union as their domestic market. If they are the first to look at national markets rather than the banking union, well, then we will not make a lot of progress going forward. So I think they should also take responsibility for this.
Let me get a response to that from Jens Henriksson, an industry point of view. And Jens, if I can just add perhaps another thought. You talked about trust earlier on in your remarks. You talked about trust having declined after the financial crisis in the banking sector. Do you think that a common deposit insurance scheme, the missing pillar, would actually help to build trust?
No, that's a complicated question because, of course, it would build trust. But this is, or might be, a burden-sharing system. And the question is, sort of, in order to for politicians to deliver on this, they need to decide what is the most important thing. And do I wake up every morning and think that the common deposit insurance system is the most important? Nah, to be honest, not. I think that political capital can probably be used somewhere else. Because in times like this, with crisis, there are also opportunities to take a step forward with Europe. And you need to decide where you want to do this, and is this sort of really the place you want to put all the gunpowder? That is my question. Then referring back to sort of thinking about using the whole euro, sort of the whole banking union as a place where you can do business. Well, we do that in Estonia, Latvia, and Lithuania. We are the leading bank in all three countries, and we learn from each other, and we try to be that bank within the flows, and I think we've succeeded pretty good. So we are using that. Then we have the issue, when will Sweden join that? And that's a complicated issue. If somebody would have asked me a year ago, what do you think would have come first, the euro or NATO, I would have said the euro. Now we're slowly getting into NATO. Let's see if there will be a renewed discussion about the euro, because then the banking union. But I've always been in favor of the euro, but Swedes have not.
Can I just ask you, before you turn your microphone off, does the lack of EDIS actually hamper your operations in any way, in your activities within the European Union?
Nope.
Thank you. Megan, let's now talk a little bit about whether EDIS would top your list of things that need to be improved when we look at the overall health of the European financial sector and banking union, essentially coming back to the remarks that we heard at the outset. Given the challenges ahead, do you think it is now more crucial than ever to build that pillar? And what else would be your top priorities when you look at the overall CMDI?
Yeah, so I take Jens's point that if I had to use all my political capital on one thing, it might not actually be on banking union. In the U.S., for example, we had political and fiscal union before we had, the FCD. So, I think that might be where I put my political capital, in which case Next Gen EU funds should be expanded and used for other things. But within the context of banking union, I would say that EDIS would top my list. It could help to finally break the sovereign bank doom loop, which still exists, and in some countries like Italy is still pretty tight, actually. So I think that would be important, but not just in terms of setting it up, but also in terms of keeping competences under the same roof. So I would take the Single Resolution Fund with its ESM backing and make that EDIS, and then you have resolution and deposit guarantee schemes unified, which makes sense given that resolution has implications for deposits, and so I think that makes sense sort of intellectually if if we're honest. And then you can free up, to John Berrigan's point earlier, you can free up national deposit guarantee schemes so that they can become investors of last resort and can be used to kind of top up the MREL so that you can have bank resolution. So that would be the top of my list, but that seems to be at the top of many people's lists. So I'm just going to highlight a few other things. I think one way to achieve that might be to strike a deal between that and limiting sovereign exposure of banks. Those seem to be kind of the two opposing points. Some want an EDIS and some want to reduce risk. And that has been the battleground we've been on for years. It seems to me like maybe you can move on both fronts. You're going to have to. One side's not going to win. But limiting sovereign exposure of banks to their own sovereign debt, I think, would be important, though politically unpopular. That would also help break the banking sovereign doom loop, which, as I mentioned, is still intact. I would also shift emergency liquidity assistance from national central banks to the ECB. ELA, as you know, is provided by national central banks. There might be some national interest in providing it. If you go ahead and admit that banks are in trouble, then investors might start to pull their money out of banks, out of countries which are fiscally exposed. And so if you were to shift that to the ECB, then there would be more of a European interest injected into it rather than just a national interest, and that could cut down on all the forbearance that I was mentioning before, whereby the write-downs end up having to be much bigger. And then in line with my comments before about the public interest test, it seems to be the default generally that banks will go through a liquidation on the national level. I think we should change the default to, for big banks to being bailed in as part of the single resolution infrastructure, and that it's up to member states to demonstrate that national insolvency law is in the best interest, not of that member state, but of the Eurozone. And I think that might expedite the resolution of some of these banks as well.
Thank you very much. I just want to ask whether there are any comments on what we've just heard before I move over. Yes, please, Sean.
I don't want to leave anybody with the impression that I lie awake at night thinking about EDIS every night. We don't. But I think there are kind of three reasons why we tend to keep going on the EDIS question. One is intellectual. It is just that if you have a single banking union, a single jurisdiction, then it seems intellectually correct that all depositors should enjoy the same level of deposit protection, no matter where they are geographically. So that, I would say, is an intellectual point. I think there's a practical point. You only worry about deposit insurance when you have problems. So I'm glad you don't lie awake at night, actually. But those of us who think about problems see it as a sort of the parallel to the resolution framework. You have resolution, you have the SRF, which stands behind the bail-in. So the first port of call is the bank's direct stakeholders. Then there's the banking system stakeholding, which is the SRF. And then, of course, there's the state which lies behind that. You have a parallel in liquidation. Again, we have insolvency. You go directly to the bank stakeholders. But we're missing the complete external funding, which is the EDIS. Because as I said, and I hinted at, if we put the crisis management framework in place as well as we can, there's still always a risk that the national DGS runs short of money. And the DGS directive, as we have it now, allows for the state to stand in, which, again, is not in compliance with the principles we've set ourselves with the resolution framework, which is that the taxpayer is protected. So, again, we need to kind of complete that arrangement. And then lastly, and here I just be clear, it's a political issue in the sense that we have collectivized the decision-making processes around supervision and resolution, but we have not collectivized the consequences of those decisions. Now, maybe they're not so big, but this is a political commitment, and I think some around the table of the political level feel that that commitment should be met. Thank you.
Thank you very much. Then, before we close this part of the discussion and open to the audience, let me just come to Sebastiano with one last question, since this is, of course, a panel on resolvability and readiness for crisis, to ask you about Sberbank, because, in fact, the SRB has recently been overseeing the failure of Sberbank in Austria and its subsidiaries in banking union countries, Slovenia and Croatia. So what have been the main challenges, and what are the lessons learned that you also would say should be taken into account when completing the review of the CMDI framework?
Well, first of all, in terms of the challenge, why it was a challenge, notwithstanding that in the end this was a fairly small banking group, 13 billion overall, and even smaller in the banking union. But it was a challenge because, first of all the parts of the group simultaneously failed. So it was a real cross-border case. Second, it was unprecedented in terms of the uncertainty, the geopolitical tensions created because of the looming sanctions. And therefore, both in ongoing and in going concern, there was a lot of uncertainty about what to do, both for potential acquirers and for the best tool to use, because there was a cut-off of funding from the Russian owner to the parent company in Austria, and this, coupled with the uncertainty and reputational issues, created then the run on deposits and therefore the liquidity issues. So it was an idiosyncratic liquidity crisis driven completely outside of the bank, from the balance sheet, from external factors, and it was extremely rapid. So this was a challenge for our decision-making, for our cooperation procedures, because we had to accelerate everything, notwithstanding that, of course, the authorities, the ECB and the SRB, were monitoring. There was, unprecedented in terms of its rapidity. Second, there were also the challenges, that was very helpful, by the way, to use the moratorium tool. We used for the first time, after the approval of the banking package, the moratorium tool, and this was a primer for the SRB at European level, and I will come back to that. And again, as it was mentioned already, the insolvency proceedings. So, we have as many results in terms of insolvency, as many member states that we have in the banking union. This is not optimal, of course, because particularly when you have to run the PIA to decide whether the bank has to go into resolution or liquidation, well, the result also depends on the national insolvency framework and the particular hierarchy that you might have in certain cases. So the no creditor worse off test, which is the test that we are obliged by the legislation to run in comparing whether the liability holders are worse off in resolution than in liquidation, this is may be affected if, of course, the basic conditions are not the same. So these were the main challenges. Now, how the CMDI can help? Well, I would say essentially we have already spoken of the general reform of the CMDI in terms of funding, in terms of least cost, etc. It is pending. After the CMDI, we have not renounced, as the ECB, to that, as Sean has said. I would say in three areas, essentially. First of all, the moratorium tool. That was very helpful because allowed us to buy time to take the best decision in the interest of protecting the public interest that we are paid for. But this is 2 days, and according to our timelines and decision-making procedures and all the actors that interact, the ECB, the SRB, the Commission, well, this was a relatively simple case. But if there were more complicated cases with bigger banking groups, bigger outreach, maybe use of the fund, well, this would have been very complicated. That's why we have already asked the Commission to consider in the CMDI review a selective extension of the moratorium period of 1-2 days, which makes a difference with respect to the 2 days that we have today. The other one is the targeted harmonization of insolvency procedures we mentioned. The third one I would mention, but this probably we can realize also without a legislative change, but however it is important also to consider that in the background, is that we have to be already, although the planning can be the best one and fit for purpose, there can be outcomes and moments where the plan cannot be used. In this case, the main strategy, the bail-in at group level, couldn't be used because it was an idiosyncratic liquidity crisis and because there were the sanctions. So it was very complicated to use that, and therefore we resorted to the alternative, which was a sale of business, with selling all the shares in 2 cases and liquidation in the parent company because the PIA proved to be negative. But however, I mean, we need in every case to operationalize better the alternative strategy if the first one doesn't work. For your information, today, out of 90 banks under our remit, which are earmarked for resolutions, the other 20 are earmarked for liquidation, as I said, 80% of them have bail-in as first strategy. And the remainder is essentially sale of business. Now, we need a functioning and, semi-mandatory, I would say, alternative strategy on which to work if the primary strategy doesn't work because conditions may change. Thank you.
Thank you very much. And we would like to open the floor now. So if you have a question in the audience, you can, I'll start over here, you can use your mic right in front of you. And please let us know who you are.
Tom McAleese from Alvarez and Marcel. Quick question. One is a bit macro and one of them is kind of following on from that. As we know, the banks are in pretty rude health at the moment based on the numbers we've seen looking back in the rearview mirror, as you say. But I think the one concern that I would have is mainly around the sovereigns. Moody's have produced an interesting graph there recently where global GDP, all debt, is at 355%. And sovereigns have moved up to the top. They have gone from 90% before COVID to about 105 after COVID, a 15% jump, which is significant. And as you know, if governments go over 120%, that looks like you're in big trouble. So if we're going through another crisis where the governments are going to be taking on more debt, what's the view on that? Number one, are we coming into a sovereign crisis? And then number two, I think as Megan mentioned about the banking sovereign nexus, we know that there is a very strong relationship with the banks and the sovereigns in a lot of countries where they're buying the issued paper, the government. So just isn't the sovereign, I think the banking sector to me is in pretty good root health.
Thank you. And maybe I'll let Megan get us started and then anyone else who would like to weigh in may do so.
Yeah, so to your first point, that debt is over 300% of GDP as interest rates are rising globally. What could possibly go wrong? I guess I'm agreeing with you that this is going to be a problem. And that in the developed world, but also parts of the emerging markets, the model that we have is debt-fueled growth, and that can only last for so long. Some economies are more vulnerable than others. I would say the U.S. is in a relatively good position, in part because we have the deepest treasury market in the world, and also because we have the global reserve currency. I didn't quite get the second question that was relating to the doom loop.
Just about the nexus between the banks and the sovereigns. I think you'd mentioned it about putting a limit on the banks holding government debt. But I think if sovereigns get into trouble, the banks are going to have problems as well.
Yeah, that's absolutely right. I mean, I mentioned flippantly that I would put all my political capital in expanding political and fiscal union in the Eurozone. That actually also gets at trying to decouple the bank sovereign doom loop. So if you were to mutualize debt, let's say take the RRF funds and expand them for the green transition and defense, and use them again every time there's a crisis, that could go a long way towards decoupling this doom loop. I think that would be useful. I just don't think it's politically likely.
Anyone else want to weigh in on the question asked? Thanks.
Well, let me say that if you look back to 2011, 2012, we had the doom loop was generated via two channels. One was the weakness in the banking sector in those countries and the asset quality, let's say, poor position of banks in those countries that fed this doom loop. And the other one was the let's say, the lack of a tool to contain, within the euro area, the widening of spreads when this is driven by unreasonable concerns about the default of a member state. I mean, both of these topics, we have made some steps. One is the banking union and the significant improvement in the asset quality and capital, let's say, position of the banks. On the other hand, there have been the decisions taken by the ECB, more recently the transmission protection instrument, and so that's also another important element to keep into consideration. Nonetheless, as supervisors, of course, you need to look at concentration of exposures in all sectors, including sovereign exposures, and I expect that as it is usual practice, let's say, the stress test that we will run next year will also have a look into this aspect.
Thank you. And I'll go over here. I'm going to bundle some. So in the far back, there are gentlemen in the dark blue jacket, and then we'll come to the two in the middle. Go ahead, please.
Thank you very much. My name is Alvaro Benza. I'm from PwC. I have a question for Sean Berrigan. Sean, you mentioned the need to rethink funding arrangements. This is definitely a very interesting and very welcome idea. The financial sector has been concerned about this for a long time, so I think we all agree that this is a very positive step. But I remember during the global financial crisis, when I had the pleasure of working with you actually on crisis management measures, we stumbled upon the problem that DGSs were considered to be state aid at the time. Obviously, this was before the resolution framework that we now have. So my question is, to what extent you think that problem has been overcome with the resolution framework we have now, and what can be done to make this possible, to reconcile the state aid framework with the objective that you were mentioning, so that DGSs can actually be used in the way you have all been mentioning. Thank you.
Thank you, Sean. I'll come to you in just a sec. I want to take one or two others. So the lady in the middle, go ahead.
Jackie Inaka from Morgan Stanley. I had a question about what the panel thinks the most key risk is to individual banks at the moment. You could argue that maybe the banks never get tested as a sector again. We're still waiting for asset quality to deteriorate post-COVID. And because of the huge government support, we haven't had that yet. You could argue the energy crisis now is seeing the same result from the government. So with that in mind, and with the significant profitability improvements we've seen in the second quarter numbers, what really is the key risk to a single bank at this stage?
Thanks very much. The gentleman next to you, go ahead.
Gonzalo Gasos, European Banking Federation. My question is about resolution tools, as Sebastiano was speaking at the end. My question is, in the few cases we have seen, the sale of business have been the most common tool, what is probably because it is the simplest one and that is an advantage. However, it doesn't promote cross-border banking because the only banks that are probably ready to know what to buy are the national banks of the same country. My question is there potential to explore the bridge bank in the future, or is it very difficult? Because that could give, I think it is 2 years in the legislation to arise the interest of potential cross-border buyers in case of a future resolution.
I'm not sure about others. It was hard for me to understand what is the potential of
the use of bridge bank as a resolution tool that could give time.
Yeah. Thank you. I had one more here in the,
Irene Mecatti, University of Siena. I have two questions, one for Berrigan and the other one for Sebastiano. As regards Berrigan, regarding the combination of the extension of resolution and the funding of resolution, we are talking about, and I agree to extend the resolution to middle-sized bank. And my question relates to the 8% threshold. We know that is not a requirement regarding the MREL because the SRB can adjust downwards this requirement according to the size, the business model, and whatever. But it's an indirect link because it's a condition to access the Single Resolution Fund. In a recent study of the EBA, it's
I'm
stated...
sorry, I'm going to have to ask you to keep it really brief if you would. Also, I will just say we are going to be talking about funding and resolution in our second panel today.
Okay, just my question is, when you said that we have to think about the 8% till-off, do you mean to delete it or to adjust it?
Good, thank you.
And the other question is for the public interest assessment. So if we talk about this later...
Just super short, if you would.
Yeah,
we're not coming back to that.
So this is not so easy, it's a complex issue. But by the way, we had the two different statements of the public interest in the Veneto case. One of the ECB, the other one of the SRB. Do you think that these two meanings are okay, or we have to revise the procedure?
Thank you very much. I suggest starting with Sean. There were a couple directly to you. Pick up on whatever you like, and then we'll go on.
Well, I'll stick to the two direct to me. How are you? Looking well. So we didn't do too much damage to him when he worked here. You remember we discovered that DGS or state aid, not because the DGS is considered to be public money, but the use of the DGS is imputable to the state. That is essentially the logic. So we never said the DGS was public, but it can be used to reach public policy ends and be directed by the state. So this is why. So I think even in the future, and of course this is why I said earlier, we need to see how the CMDI review comes out, because how that comes out will also affect how the state aid rules are framed around it. But I suspect forever there will always be a need to make sure, so long as the control of the DGS remains at national level. Now, in another world, you might think of an FDIC world where the use of the DGS would be controlled centrally, and that would be different. But so long as the DGS is imputable to the state level, I think there will always need to be a check that is not being used in ways that interfere with the functioning of the single market. But the particular rules, the specific rules that apply, I think we should wait to see how the CMDI review comes out. Now, on the 8% threshold, heaven forfend that I would suggest that we take it away. This is a political agreement. The 8% threshold is there. I think there's no question of deleting it. I think what I meant was we would have to find ways in which we might allow banks to reach it. But the 8% threshold is in law. I do not think this is going to be a subject of the review that we are undertaking. It will stay. But there are ways in which you can help a bank to reach the 8% and then access the SRF.
Thanks very much. Then I will just ask Jens if you would like to speak to the question that was posed about the single biggest risk facing individual banks now going forward, whether you think that that would be the energy crisis or something else.
I would say cybercrime.
Isn't the Scandinavian brevity amazing? Do you want to say any more?
No, but the economic development, what will happen is that we'll see quite a dramatic time coming, and I think we all know that. And I think most of the individual banks will shelter that. I'm a bit scared, as I said in my introduction, is that the authorities will then see that profits go up, try to grab that, and when it goes down, then we get into troubles. If you look on the operational issues, that's the tricky part of being sort of a CEO of a bank, because that is what you work mostly with. It's not all the acronyms that you hear here. It's IT systems, it's cyber crime, it's DDoS attacks, and all that stuff. So that is a worrying if you're a CEO, and that keeps you awake during the night.
Thank you very much. And of course, cybercrime did rise during the pandemic and since the Russian invasion of Ukraine. So indeed, it's very much on the horizon. Let me go now to Andrea, please.
No, I mean, let's say, of course, we can put our points on which is the worst risk on the table. But I think that as human beings, we tend always to generalize our recent experience. No? So we had just a pandemic, governments helped a lot, so why should we be worried? There will be public help again coming. We had the crisis in the leveraged finance sector, but the central banks, the Fed in particular, started buying a lot in that area and nobody suffered losses. Why should we worry about leveraged finance? I think there is a risk a bit of complacency now, expecting that there will be widespread public support all across the board. And I think that I would warn banks to be a little bit more, let's say, conservative in their estimations of what would happen going forward.
Thank you very much. And then over to Sebastiano, 2 points. The question about resolution tools, and secondly, public interest assessment. There was an additional question.
Well, on the resolution tool on the bridge bank, well, clearly it is at first sight a more complicated instrument, but some advancement and some reflection have been conducted also internally at the SRB in order to operationalize also this tool, and by no means we should shy away from using it if it is needed and if it is proves to be a tool that might help. And therefore, as I said in my previous intervention, when I said that we have to work more on the operationalization of certain tools, this includes also the bridge bank tool. On the PIA and comparison today with the past, well, apart that, of course, we don't comment on individual banks in detail, but I would say that the PIA has always to be run according, so you have a resolution plan which has been done to the best possible extent, but then you have to check at the point of failure. And in the moment of the point of failure, it was shown that in that particular case, this was not the case. The PIA at central level was negative. Now, of course, things change because, as I said, the balance sheet over time, this was a slow-burning crisis. Things evolved over time in terms of deleveraging the balance sheet, in terms of taking out a number of non-performing loans, etc., and therefore this was the end results where the methodology led us. Thank you.
Thank you very, very much for this very interesting and wide-ranging discussion. Let's give them a warm round of applause, please. And ladies and gentlemen, we do now go to a lunch break until 2 p.m. And please do come back punctually because we will return for a dialogue between Elke König and Bloomberg's Nicholas Comfort, with Elke looking back at the 7.5 past exciting years. And following that, we will drill deeper on resolvability. So thank you very much for your attention. Bon appétit. They ask the, oh, sorry. Welcome back, everyone. I hope you had a very refreshing lunch and time to do a bit of live in-person networking. And I will just ask those who are not seated yet to please take your places so that we can begin with our afternoon session. Thank you very much. So before the break, we were talking about some of the unfinished business of banking union. Now we want to begin the afternoon by looking not only ahead to the challenges before us, but also to what has been achieved since the SRB began its work. And who better to turn to for that purpose than the chair who has in fact been at the helm of this organization since its inception. Elke König will share her wealth of experience in 7.5 definitely exciting years in dialogue with Bloomberg's banking and finance reporter, Nicholas Comfort. It's a pleasure to hand over the floor. Please.
Thank you. And this is a wonderful moment for me too. I used to cover Elke when she was working at BaFin, reading that. Although she was Dr. Koenig to me at that stage, so it's nice to sit here.
I go perfectly well with Elke.
Well, if you would indulge me, Elke, let's take a short walk down memory lane. You've often referred to the SRB as a startup, and if I look back, the obvious parallel to your work setting up the SRB was Danielle Noui's work setting up the SSM. Maybe you could tell us a little bit, were you ever jealous that she had the assistance of this huge, respected central bank that was working? Or, were there other aspects where she had life easier?
Well, I think I would start to say, I'm tried not to be jealous, but of course, when you compare the Single Resolution Board or Single Resolution Mechanism and the SSM, the difference was we had supervision at national level for between X or Y years, so for a long time. So Danielle, and to a lesser extent perhaps today, could always say, if we don't find a solution today, we carry on what we did at national level till tomorrow, till we find a solution. In resolution, it's fair to say, not just for Europe, but for all of us, there was no resolution framework. So whatever we started was a bit, you started from scratch to find the best solution. To give fairness, some of the larger member states had started 2 to 3 years earlier, but in principle we were all starting to learn a bit, to do a bit learning by doing. So to that extent, not jealous, but greatly also happy that she always had an open eye and an open ear. Whenever we talked about something, I said, I need to get some ideas, and we were a great team to start together. We had a very weird, this is perhaps to share, we had a very weird structure. I'm seeing one of the then board members, we were 5 board members, we soon had 5 personal assistants, and I think we had 1 full-time employee and staff from the commission. Our parameters shifted in between.
Yeah, indeed. Well, maybe we can pick up on that point you were just making about some member states being further along. I'd like to look back at one of the most controversial decisions of your tenure at the SRB, and that was declaring Banco Popular to be failing or likely to fail. Now, investors in the bank suffered steep losses in the resolution, and some of them sued the SRB. And so, looking back, do you stand by that decision? And what did you learn about how such decisions need to be taken and also communicated to avoid situations like that ensued?
First, of course, I stand by that decision because I think the decision was the right decision to be taken. And let's face it, we are not an institution that miraculously makes potential losses go away. We are there to protect financial stability and to ensure that it's an orderly resolution, and equity and credit holders are the first ones to bear the losses. So to that extent, I think it was a role model decision. That we are getting sued was something that even beforehand I was always sure there is a difference between supervision and resolution. if in supervision you might think twice, you need to live with the same supervisor tomorrow, that what you do. But in resolution, well, then you might get the impression there's only an upside because the bank is now resolved, so you move and you try to challenge. I'm always a bit warning to say the downside is still that you are facing quite some legal cost if you don't obtain the result. No, I think it was the right decision. We were at that time. I would not like to repeat one thing. It was a decision on a Tuesday night. We have always talked about weekends. It's not a good idea, but we were running out of options that you have to do it during the week. One thing we learned there is liquidity can run very fast, and you might on Friday still believe there is sufficient liquidity to prepare orderly and realize that 2 days later, that's done. So.
And then, maybe, again, the last question I want to look back on is, do you think the level of political interference, as I can put it as a journalist, that we saw during your tenure, will it continue? I mean, do you think that your successor will be dealing with the same challenges? If I think of Italy and Germany basically sidestepping the resolution of relatively large banks with taxpayer funds used via the insolvency process or even a direct recapitalization, is this something which you will continue to have to deal with?
I think in our situation, you always have to notice that, of course, when it comes to individual banks in individual countries, politics will have a view on what they think is the best solution. I would, for me personally, say then you are you're carefully listening, and then you take your own decision based on the legal framework. If you are really the one who thinks he can, or if someone can be pushed around, that's probably never the best decision. Think about, listen to everyone, but then decide that this is not a political exercise, it's a very technical topic, and try to take the best decision. Does this change? Does it get more? Does it get less? I think it will be always the same. Be it at the national level or be it at the European level.
But still, I want to push you a little bit on this. I mean, is my interpretation wrong? Were there cases where you thought over time, this bank belongs in resolution, and what are we doing here? I say that undermines the credibility of the existing framework.
I think, honestly, when you look at it, in some cases, but I would not put it just to political pressure, you get the feeling, isn't this taking far too long? Isn't the white knight just around the corner? But it has been around the corner now for a while. So this is the challenge of the system. You cannot declare a bank failing or likely to fail if you're not meeting the criteria for failing or likely to fail. Are there sometimes, I would call it creative solutions to just avoid that exit? Well, some people have heard me saying this. Sometimes it feels within the current legal system that we are like on a French highway. You always have a last exit in front of péage. So this, I think, is a topic we need to address because it's clearly embedded in, topics that hopefully will be addressed by CMDI.
Okay. I should take that piece of advice next time I go on my holiday in France. So you don't strike me as the kind of person who would leave your successor with a to-do list or sort of commands chiseled into stone. But surely there are, just by the nature of this institution, there are there's a workflow underway now, which will continue and will feed through into the next chair's tenure. Maybe you could tell us a little bit about the priorities that you're working on now, what's important to you, and how that will be left to your successor.
Well, I think first and foremost, no institution hopefully will ever change entirely just because the chair is leaving. the chair is replaced, but the organization is still there, the teams are there working on their topics, so I don't overestimate this. For me, it's pretty clear. We have our work program, which and it was mentioned earlier this morning, the expectations for banks that we had crafted run till end 2023. So we are in the final stretch of really addressing all topics to make banks resolvable. This is number one. It's the last and probably difficult nuts to crack are liquidity in resolution, how to project, how to ensure on the bank side liquidity is still available, and also management information systems. The latter one will be an evergreen. Management information systems in banks are always something that is better tomorrow. Unfortunately, already since a number of years. But on the other hand, it will be, the organization there, I'm convinced, will change a bit because, and I think Mr. Hendrickson mentioned the resolution plans. Well, you write a resolution plan, you maintain it, but you're not rewriting each and every year a new resolution plan. So you reach a kind of steady state in resolution planning, and you move far more as the SRB into testing, into doing deep dives on certain topics. And for the institution itself, for us, we have been resolving Banco Popular, we had Sberbank. In both cases, it was a very straightforward, plain vanilla sale. Now you can think about far more complex strategies with a non-performing loan portfolio to be kept, with a lot of guarantees around, with a deep bail-in and restructuring, or, as was mentioned before the break, with a bridge bank, which needs to be managed and then brought back to the market. And I think here we are currently, and we need to focus on, working really that the internal setup is that for each of this, we have at least the starting point of an answer. Each crisis will be different, but a lot of work in this respect needs to be done, or as Sebastiano mentioned, for cases where you have a preferred strategy. So what if the case is slightly different? What's your alternative? In particular, looking out at liquidity. So I think it's a bit deeper, it's moving within the same topic, but in the end, it's also for the new team then to see where they put their priorities. And I've always promised no grumpy letters and no remarks and good advice from the sideline.
Okay. So let's build on this a little bit. So the next chair faces a different set of circumstances than those that you started with. We came in on that. So both in terms of the institutional setup of the SRB, it's a running institution, so congratulations on that. But also that banks are supposed to be fully resolvable by the end of 2023. So will banks be fully resolvable by the end of next year? And does that allow your successor then to focus on other issues, maybe sort of bigger picture, more strategic issues as well?
I think it's, in fairness, I ideally hope that the banks have addressed all topics by the end of next year, and most banks by the end of next year have also built up the MREL that is going along with it. Some banks have a bit more time for specific reasons. Will this mean that that resolving a bank is a walk in the park? No, never, in particular not for the very big banks. So this is why I think this focus then on data, the focus on really testing individual topics, or, for example, it's very easy to say that you need to bail in the debt, or you downstream capital, upstream losses. And then you talk about a multitude of countries, a multitude of entities. So there is a lot of testing needed, otherwise your weekend might be a bit too short. So I think it's more work to be done, but it's shifting into the more testing and work compared to the conceptual development. And it's also, which has always been a plea from the industry, from our plenary, in consistency. So quality control, assessing where do we really stand. For the moment, the glass is definitely half full, but it's not full. Not sure whether it will ever be full.
On MREL specifically, so there's flexibility for some banks. Do you envisage that there could be more flexibility for the industry as a whole? I mean, given that who knows where the economy is going, where energy markets are going, and banks' funding could also, we're going to have we have rising interest rates. Is that something that more banks could be given more time to build up those buffers?
I don't know. I think this is something which will always be a bank individual decision. Of course, currently funding markets are anything but easy, but I would also not say it's black and white. So there might be the one or the other bank that for very dedicated reasons gets a bit more time, but be aware, more time. First, the legal framework is limited for this, and secondly, more time means also that resolvability moves a bit out. I would rather believe, because you mentioned the difficult times, for the time being, as was mentioned also during the previous panel, the bank's profitability is better than it has been for a very long time. And I think the last time I heard fantastic profitability, the underlying balance sheet quality was not the same. So this time I think balance sheet quality and profitability seem to be on the same, going hand in hand. So I think we have a good starting point. Rising interest rates will probably, not in each and every case, basically support profitability. It might, for some banks, it might be a very difficult and challenging transition. And on the other hand, I think you don't need to be a rocket scientist to see that credit risk or cost is rising. So it's a bit a mix, but in any case, let's be prepared. If something goes wrong, hopefully not too often, to be able to manage.
I'd love to come back to the environment towards the end of our conversation, but there's an issue which I'm sure the industry practitioners in the room are very keen to hear you speak about, and it's the SRF. Now, you've always said that you're a rule taker, not a rule maker, but how do you see contributions developing from here on out to the SRF? Will banks be able to breathe a sigh of relief, and once you get to 80 billion euros by 2024, or do you think more money will be needed?
Do you have an easier question? Let me try to say, we are indeed a rule taker. The legislator has defined 1% of covered deposits. Why 1? Why not 2? Why not 0.5? They defined 1. The SRB has tried to build up this fund over the last years, and this was why the numbers kept moving. We saw an incredible increase in deposits for various reasons. I'm not sure what it looks a bit like. 2022 is more flattening out, so let's see where we are at the end. I've always made a bit the joke to say the legislator who defined this was at least not a mathematician, because we were asked to build up a fund in equal steps to an unknown target. Your math lesson would tell you can close the book, this is unsolvable. So we had to adjust year by year. 1% is the maximum. There is very little leeway for us we had a discussion in the very beginning, but we also had it last year, about potentially allowing for more guarantees. Well, the board in its majority decided against this for the moment, but this for me stays always as a topic. But the more important part is, I don't see any political appetite, I don't even see any real logic to say we need more. So 1% for me sounds good. Unfortunately, our backstop is still held hostage by the ESM treaty reform. Otherwise, we would have the backstop. But then you also need to consider that if something goes terribly wrong, the industry has to refill this. So there is quite some, you can't go into higher levels. There is one area which I think we need to really think about. we always look what the Americans are doing. We sometimes forget that their FDIC is 80 years old and a bit older, so we have still some time. We should not make the same mistakes in between, but fine. But the FDIC has a fund of 2% of covered deposits, roughly. They have one fund. We in Europe have the SRF, in the end 1% covered deposits, and then we have 21 plus deposit guarantees funds, national deposit guarantee funds of 0.8. So we have basically the same level of safety net. Ours is just a bit diverse, or to use Pooh, the beer, the honey is in a lot of pots and you need to find the pot, and you might not be finding the right pot in the right case.
Well, in everyone's interest, I really hope that the banks don't eat through those pots as quickly as Pooh does through his honey pots. But maybe
that's for sure.
Maybe, but if we think about, let's say that honey pot does get eaten up. How do you think that there's room to change the mechanism for how a bank's contributions are designed and raised? Because this is something we hear as journalists quite a lot from the banks. They complain it's an opaque process, and sort of we feel that we're being unfairly targeted. Funnily enough, banks from across the spectrum, every single bank feels it's being unfairly targeted.
You have to pay.
But is there, if we do have to top that up again, should we be thinking about a change in the way we calculate?
I think, as we had been also pushing a bit the Commission during the pandemic to say, do you want to pause or the like? I think let's be realistic. There doesn't seem to be any political will to touch this topic right now. And due to a lot of agreements around, it needs unanimous decision by Council. So this makes it a bit difficult to move. I personally would say the system is very complex. The SRB and our team is doing really its utmost to be very transparent, but you can only be transparent to a certain degree because it's I don't even know the English word for that. It's a system where everything depends on the overall banking system. So you're not calculating a bank's contribution from A to Z, but the bank's contribution is depending on the entire country's contribution, so you always have a bit.
What would the German word be?
Inhundert.
Inhundert?
Yeah.
Germans have a word for everything. It's wonderful. Well, maybe can I ask, are all banks really resolvable? And I'm not asking this question to be sensationalist, but if you had to resolve a GSIB this weekend, or even in 2 years from now, do you think that the world, the systems the bank has in place are really up to the task in order to get that, to pull it off? And can the authorities coordinate to the degree that's needed to actually handle that kind of cataclysmic event?
I've always said whether we resolve a GSIB or whether one of our industrial giants is failing, it will not be a pleasant moment on Monday. This, I think, we all need to agree. Do I think that we have the tools at hand? Yes. I dearly hope that this is, when it happens, is a slow-moving crisis, so you have the time to really prepare, because otherwise a weekend will just not be enough time, and it will not be enough time already for a very simple reason. Let's assume when you talk about a GSIB, you talk also about using the fund. Well, as of today, if you are supposed to use the fund, you need to have a pre-approval by the Commission, because the fund is considered equivalent to state aid. So you need first the failing or likely to fail decision. I'm seeing some of our friends from the ECB. It might take a bit of time before we get their draft. So then the first day might already be spent on sorting this out. Then you need to consider the pre-approval. Well, then the weekend is probably gone. So I think we have a very complex framework, and there was this one German MEP, who is now state secretary, who said, will it ever work? I think we proved it worked twice. It works if you all work hand in glove. And there I am very confident that the cooperation we have as of today, be it within the European system, so looking at Andrea, be it with our US counterparts, our UK friends, is miles better than it has been. Will there be some hiccups in? Probably sure, but it will not be that you wake up in the morning and you find out that someone took a decision which you think we could have talked about it, please, before. And I think if you want to take a bit of confidence out of the very small but very fast developing case of Sberbank, these were 8 different countries. Now, not all were all the time around the table, but any decision and any communication between the countries was very well coordinated. Our Czech colleagues had closed the bank basically on Friday lunchtime, but they tagged along with us in everything they communicated so that they were not causing even more problems. And I would expect we have an ongoing cooperation, it's called trilateral exercise between US, UK and us, that this will really help to ensure that we all understand the needs and that we can only go together in this case. So but it will not be a nice weekend, and I don't hope it for my successor.
I think no one hopes for that situation. But if you mention Sberbank, that is a bank that was, as you said, was international in depth. There were actually was coordination.
Yeah.
Okay. Well, maybe the lever the banks have in this case is to prepare a good resolution plan. And we heard from the Swedbank CEO this morning saying maybe 500 pages is not the most efficient way. Should we be thinking more along the lines of the one-pager, or should it fit on a beer mat, as a famous German politician once said for tax systems?
Well, that's depending on how small print you can write, probably. No, I think one page is probably unrealistic, but I agree, and in principle we are working along these lines, that you probably will not find the time to open up a 500-page document to find the information, then to find out that it's actually 1 year old. So, but what you have out of these plans, and what helps, is that you have a very clear understanding of what bank do you have, what are the operations, where are they. So then you need definitely, at least for someone like me, the executive summary to know what are the most mattering points. And this goes a bit back to the first question, where do we need to work? I think over time, it's also after your first round of really getting an inclusive and a whole resolution plan, it's about where do we need to put more emphasis in, and where can you also say a principle is sufficient, because this anyhow comes after the first step. So it's a bit this testing which might help.
Okay.
1 page I don't believe in. 20 pages probably a good idea.
Okay. Maybe we can turn to some current events. Before we talk sort of more big picture, I think many people would be interested to hear, are there other units of Russian banks out there who you are watching very closely? I mean, I'm thinking, obviously I can name names, but in Germany we have VTB Bank Europe. I mean, there was the case in Cyprus, which is now done and dusted. In the Netherlands, are there other little banks that we should have on our radar?
Well, you know that I don't talk about any banks, but I think what we've seen through the sanctions is that basically the footprint of Russian banks in Europe has disappeared.
Yeah. Okay. And then maybe if we think about sort of the impact of the fallout for European banks, then. So we've heard a lot about, from the banks, thinking about sort of expecting support to continue for the economy, but we also had Andrea this morning saying sort of like, don't be too enthusiastic about sort of don't be too complacent. Sorry, I should quote people properly. But so do you think that there is a risk that as there are second and third order effects, individual banks in Europe you will have to declare them to have failed?
I don't know. I think for the time being, I get the feeling, as I said, the starting point is a very sound one, profitability-wise. You also, and I firmly believe, that the assessment of credit risk has dramatically improved, not least due to our friends at the ECB being in the bank's back. Will there be failures of banks? Well, of course, it's a normal business, so there might be the one or the other. I'm a bit concerned, as I said, that credit risk will come up. The mitigating factor of positive rates will be helping. But let's see where the entire cocktail goes. But nothing that I would say for the moment that makes me nervous.
Okay, but credit risk is a pretty big, broad term. So within that, are there particular sectors that keep you up at night? Is it the energy sector itself? Is it sort of steel makers or bakers, or where do you see what has you worried?
As a private person, I'm concerned about the bakeries because I want to keep them, but that's something else. No, I think as I said, it's a cocktail. On the retail side, we have seen very favorable mortgage conditions in the past. Well, now you have some countries that have floating rate mortgages, and the mortgage rate might move in a direction that your income doesn't move in. In other countries, you've got fixed rate, particularly Germany, for example, but then you need at some point to refinance. So this is one area. And of course, with the rising cost of living, the ability to honor your loans might decrease. Now, not gigantic. There are subsidies to some extent, but it's at least a topic to watch. And on the industry side, well, you can't say the energy sector. As we all know, there are some that earn tremendous amounts of money and others that are in very difficult situation. But I see that in general, with rising and dramatically rising energy prices, also other industries might get into trouble, including the bakers.
Yeah.
So this is the cocktail to watch, and it's up to the banks to see, as was mentioned before, in which industries they're exposed, and to really assess their credit risk. And I was very thankful for Andrea mentioning that no one should believe that there is somehow unlimited, here is a problem and here is government money to fix the problem. This just can't work. We had always said during the COVID pandemic, at some point there needs to be an exit, and we need to see. But I think for the time being, let's see how things are developing.
Okay. Well then, let's turn to a very relevant topic here in Brussels, but our audience also online probably knows a little bit less about sort of the stopping and starting of attempts to move forwards to banking union. There was a lot of gloom. I don't want to say doom, but there was certainly a lot of gloom on this topic in the last couple of weeks when the Eurogroup failed to agree on a single work plan for banking union. But let's focus on maybe some of the specifics that of what you mentioned in your speech this morning for the next few years. What's important to you to see in the review of the crisis management and deposit insurance framework? What are the quick wins we could see?
I think for me, and we've said that constantly, is harmonizing, at least basically harmonizing the insolvency procedures for the banking industry. That's one area, so that you have a fit-for-purpose system for exit, and within a resolution you have a counterfactual you can build on, and not different exits there, or you postpone any decision because you fear that your system is not ready to handle it. That's the one area. And the other area, and it's a bit linked, is deposit guarantee system. I think it's important to really say, when we talk about the middle class, and we did this morning, we are not talking about trying to find a free lunch for competitors to the larger and the smaller banks. We are really trying to find a solution that allows us, if a bank fails, to have it orderly exit the market. And I think for me, to be correct, this first and foremost means it's for creditors, for equity holders and creditors to pay for this. It's called MREL. And to be resolvable, but to be also clear that we should probably have a really close look at our deposit guarantee system to say, does any deposit guarantee system allow what is called alternative measures so that the DGS can support a sale? Well, if it does, it's not unlimited, so you need to think about what is the amount the DGS is at risk with. This is what was mentioned, the least cost test, which should be a fairly realistic assumption. Where are you better off? In an insolvency or trying to use, well, the Americans call it purchase assumption, it's a sale transaction at this point. And to be fair, to get this done, it's all a bit linked, you need to think about the depositor super preference, because within the history says, within bank failures, the amount of capital that in the end is still there has always been sufficient to basically repay the DGS. So, therefore, the alternative, as long as we have seniority, is zero. So you can't do much if you say my alternative is I have no cost. So these are the topics to be addressed. And I think with that we can go a long way. That in the end, and to use my least little remaining Latin, and then Sebastiano will say he doesn't understand my pronunciation, is ceterum censeo, we need EDIS.
Okay. Well, a big ask. But I do have to follow up on that. I mean, not all deposit guarantee schemes for the consumer audience at home are created equal. Not all are as full, not all are as competent either, or have as much experience. So is this a bit of an easy answer to say sort of, well, a bigger role, an earlier role for DGS because they can jump in and save us the problem? But I mean, would we be actually be handing a task to someone who not everyone can carry it out?
Well, I think I'm staying optimist. I think first you need to really enable this alternative measures, so to support a transfer is an option within the current directive. Well, it shouldn't be an option, it should be a must, and it should be clearly defined up to which level can they contribute. And then it's probably like we have it within the single resolution, we had it in the single resolution board at the start. Not all authorities were at the same task. Then you need really to work together. For me, in the end, whether a bank is put into insolvency, it's managed with the support of a DGS, or it's a resolution. If you think it longer term, it's about a bank exiting the market, so probably far more cooperation between the resolution authority and the national authorities. And now we have a very excellent cooperation with our national resolution authorities, but also good cooperation with the national DGSs. Well, in some cases it's the same authority, in other cases it's different, would be needed. It's not a walk in the park, by no means.
Okay, and we're approaching the end of our conversation, and unless there are some questions from Twitter, I mean, sadly the audience today, I've been taking all your time, and I get to ask the questions. But as we have questions from Twitter, I would be wrapping this up. Do we have questions from Twitter? No, we do not.
Okay.
So, as I mentioned at the outset, I've had the pleasure of reporting on two institutions you've now led, and they never failed to produce news and be right in the thick of the action. So thank you for
You would be disappointed otherwise.
No, exactly. It's sort of the day we have nothing to write about, more crises. Thank you.
No, please not.
Maybe you could tell us, so your term ends on the 23rd of December, so I have a pretty good idea of 22nd. Pretty good idea of your immediate plans. They probably involve good food and good cheer and exactly and and a Christmas tree. But will your next act provide me and my colleagues in the press as much excitement as the last two?
Honestly, I don't think so. No, I had quite a long time in business. For the time being, I will take a deep breath. If something pops up that intrigues me and it's not my grandchildren, I might think about it, but otherwise I'm not desperately looking around to find something to keep me busy.
Okay. Well, there are a lot of energy companies that might need to be wound down at some stage, so just a tip maybe.
Well, most people know my address, but I will also be realistic in what I can and what I can't.
Indeed. Well, please join me in thanking Elke for this interesting interview. And it was a true pleasure, Elke, to report also on the institution and to have this conversation today. Thank you.
Thank you. Thank you.
So.
Thank you so much to Nicholas Comfort and to Elke König. What a wonderful way to fill the sometimes difficult slot right after lunch. It was indeed very, very interesting and also at moments entertaining. So many thanks to both of you for that. And we will be picking up on some of the themes that we've just heard there involving resolvability and also funding in resolution in our final panel later today. But first we have a keynote to look forward to. And I'd like to come back to what we talked about before lunch during our first panel of the day, when there was consensus that we do indeed face quite a challenging environment due to the confluence of crises on hand, and that makes the resilience of banks especially crucial. And I believe that I am accurate when I say that our keynote speaker certainly seems to agree with that. He has recently warned that Europe does face a recession ahead. I think you said limited recession, but that was about 10 days ago. Maybe you would now take away the modifier. And you issued a very forceful call for banks to keep sufficient capital in reserve as we move into this very challenging period. So let us hear more now from the governor of the Banque de France and also the chair of the board of directors of the Bank for International Settlements, BIS. He is François Villeroy de Galhau. Please, the floor is yours.
So, ladies and gentlemen, dear friends, thank you for your kind words. And let me stress that it's a great honor for me to be with you today. And I would like to warmly thank Chair Elke König for her invitation to give this keynote speech. I don't know where Elke is, by the way. She disappeared. She is so modest. So let me use her absence to pay tribute really for her outstanding contribution to the birth and the growth of CRB. And let me say it also to SRB staff. You can be proud of this creation and development. Believe me, it was not obvious. By the way, you have a strong ally in France, with whom I have a great pleasure working each and every week, Dominique Labourex. I won't be betraying any great secrets by saying how much Dominique enjoyed taking part in this creation and how much he remains attached to the SRB. I come to the title of this conference, European Banks Resolvable and Ready for Crisis. It may cause some anxiety, and you raised anxiety, by the way, in your introduction, but it's a healthy type of anxiety. It reminds us of possible dangers ahead and serves as a strong reminder of what happened to banks during and in the aftermath of the great financial crisis. I mentioned, yes, 10 days ago, the possibility of a recession next year. I added that in that case, it's a possibility, it's not for sure, this recession would be limited and temporary, I can reassure you I don't have any downside forecast to make. I won't change any qualification. But the temptation to forget about past events would be a huge mistake. Lessons of the past should remain vivid memories that motivate us day after day to build a safer system. The philosophy of resolution, if I may use this word, is rooted in those rough times. We do not want to live again under the threat of too big to fail or in the absence of living wills. EU lawmakers and regulators, fortunately, quickly learned the lessons. Beyond the crisis management regulation, BRRD and CRR, the banking union, launched 8 years ago, is in its own way an illustration of Clausewitz's military theory, if I may, Elke, quote a famous German author. Banking union has strategic objectives, or Ziele in German, establishing a stable, safe and reliable banking sector, but also offering the right conditions for the emergence of pan-European groups. It also set political goals, Zwecke, through its 3 pillars. And lately, it has directed its effort, Schwerpunkt, I will now switch back to English, mainly and maybe excessively towards the 3rd pillar, EDIS. Today, we should turn our main efforts to enhancing implementation of resolution in order to make it even more efficient. Although it is less frequently commented on, let me stress that resolution is as important as supervision, and you know, caro Andrea, how much supervision matters. Let me put it in Latin, as you, Elke, did some minutes ago. Si vis pacem, para bellum. If you want peace, prepare for war. Coming to a concrete and operational perspective, I will first give a few personal suggestions on several issues you have been discussing, including this conversation with Elke since this morning. On first, how the resolution framework, after this successful start, could evolve over the coming years. And second, why and how supervision and resolution authorities could work more closely with one another. First, about possible evolutions over the coming years. Resolution currently stands as the only harmonized crisis management framework at EU level and is therefore a public good to be preserved and enhanced. After 7 years of determined preventive action and 2 successful resolution decisions, how can we take advantage of the upcoming revision of the crisis management framework? Primarily, according to me, we should broaden the scope of banks that could be subject to resolution measures by considering the regional impacts of a failure in the famous public interest assessment, PIAs. The SRB and some national resolution authorities have already taken a first step in this direction. I very much welcome this evolution, which in my view could go one step further to enable medium-sized banks to be subject to resolution measures. Yes, if the PIA concludes that there is a public interest in doing so. We would naturally have to determine the criteria for identifying medium-sized banks and for excluding small banks whose limited footprint would never justify resolution. Furthermore, instead of focusing exclusively on bail-in, resolution planning could ensure that the whole range of currently available tools are considered. Finally, some efforts should be made, and you mentioned them, to harmonize the main features of national insolvency proceedings, such as creditors' hierarchy, rather than creating parallel crisis management paths, which would simply duplicate the existing resolution tools while triggering significant level playing field issues. Once these steps are taken, the probability of recourse to the Single Resolution Fund, SRF, could increase. However, while the initial objective was to reach 1% of the covered deposits, such a goal being evaluated at that time at an amount of 55 billion euro, this amount has been constantly revised up, and the SRF represents today 66 billion euro and will reach around 80 billion euro next year. This sharp increase can obviously be mechanically increased by the surge in deposits in the wake of the COVID crisis and the forced savings. The fact remains that this very high amount has never been used so far. We cannot completely ignore this question. It can be discussed whether this amount is disproportionate somewhat compared with European banks' level of risk. If the answer would be yes, then we could contemplate introducing a ceiling in absolute terms, the level of which would have to be determined. We could also use the flexibility offered by the current regulation to alleviate the burden of contribution by the banks so that irrevocable payment commitments can represent up to 30%. I come now to my second point about why and how supervision and resolution authorities could work more closely with one another. Cooperation between the SRB and the ECB does exist and is formalized by a memorandum of understanding. This provides for ex-ante coordination in calm times and closer cooperation in early intervention and resolution phases. Beyond the current areas of cooperation, which could still be enhanced in practice, greater coordination on policy issues appears desirable. In particular, policy decisions that pertain to own funds have a very concrete impact on European banks' competitiveness, and therefore on the level playing field with foreign banks. Here, we must find a delicate trade-off between safety and competition issues, with efforts possibly needed on both sides of this cooperation. For instance, the SSM could further consider a risk-based approach rather than a flat-rate approach to estimate post-resolution Pillar 2 requirements. This entails a need to take into account a forward-looking approach and the expected risk reduction that follows a resolution. This should be acknowledged in the calibration of MREL. Banks are not at the same stage today as they were 7 years ago. I don't forget some possible progress from the ECB itself in, for instance, sharing more of its monetary statistics for the need of resolution. And I know, Elke, and probably Andrea, that this issue is dear to your hearts. I strongly support you. The resolution authorities could, in turn, in this better cooperation, better take into account certain strategies and thereby accept a certain and appropriate level of risk. A likely effect of recovery options or transfer tools is that the structure of the remaining group might become less complex and therefore carry less risk. Besides, the stance of waivers of internal requirements for entities located in the same member state or even in the same banking union has probably sometimes proven overly conservative. We need pragmatism and consistency between the SRB and the SSM. When an entity has been waived from capital requirements or is simply not subject to capital requirements, the resolution authority could apply the same on MREL. Proportionality to risk, let me add this last consideration, could entail other changes, such as the calculation of banks' contribution to the SRF. As of today, the size of institutions has an overwhelming importance in the determination of this contribution. This could be questionable. Size does matter in order to bring an institution under the scope of a resolution, but size and risk are two different notions, and they could be more clearly differentiated in technical implementation. In order to ensure the fairness of contribution and greater adherence to the SRM overall, it is necessary to adapt formally accordingly. Beyond fairness, penalizing the largest groups prevents the emergence of pan-European banking groups, which is one of the banking union's objectives. Here, let us acknowledge we have collectively failed so far. We have a banking union, but we don't have really cross-border European banks. This is a major weakness, and I know, Elke and Andrea, that we regret it together. This is where we should bring our Ziel, our strategic objective, into our field of vision. Let me conclude by saying that in 2022, after the first 7 years of success in the creation of the single resolution mechanism, it's time to recall what Clausewitz also rightly identified as the greatest difficulty, I quote him, to adhere steadfastly in execution to the principles which we have adopted. And Clausewitz did not mean showing rigidity in technical implementation. It means taking a risk-based approach and conducting a balanced analysis of the best way forward in order to serve these principles in a relevant way. I will quote another famous phrase of Roman wisdom, in medio stat virtus. Virtue lies in the middle. But let me conclude, liebe Elke, by, if you allow me, speaking in German. Darf ich im Namen Europas einen großen und herzlichen Dank für dich ausdrücken. Vielen Dank. Thank you for your attention.
Thank you very, very much, Governor, and I think I will translate. I'm sure Elke was glad that it was in German, so, but I'm going to translate it. The Governor thanked Elke in the name of Europe for her very great contribution, and very gracious. Thank you so much, and thank you for your very clear words in terms of how we can best deal with the risks that we do face. And we will pick up on a number of your suggestions and also on what we discussed or what Elke and Nick discussed in their dialogue now in our final panel on resolvability. And may I ask the panelists to please join me on stage, and then I will do some brief introductions. So a very, very, very warm welcome to all of you, and we are very pleased that you can join us today. And I begin with the lady next to me. This is Tuija Taus. I hope I more or less pronounced that correctly. She's Director General of Finland's Financial Stability Authority and previously head of unit in the Financial Market Department at the Finnish Finance Ministry. It's wonderful that you can be here. Thank you so much. And in the middle, a familiar face, a very welcome return guest, José Manuel Campa is chairperson of the European Banking Authority and formerly Director of Regulatory Affairs at Santander Bank. Welcome. And finally, on the outside is Pedro Machado. He's member of the board of the Single Resolution Board. And online, hopefully, we have Claudia Buch with us. She's Vice President of the Deutsche Bundesbank, overseeing the Directorates General, Financial Stability, Statistics, and Internal Audit. And do we indeed have her with us? We're not seeing her at the moment, but hopefully we will see her when I address her. Trust. And ladies and gentlemen, for those who are watching online, please do send us your questions to our Twitter hashtag SRB Resolution 2022. And of course, we will also open the microphones for the room toward the end of the discussions. And just now, Elke König in that dialogue shared her view that the work done by the SRB and by banks on addressing resolvability is paying off. She also, however, and we heard this as well from the governor of the Banque de France, does see areas that require further attention in 2022 and in 2023. So I'd like to ask all of you, dear panelists, to pick up on the challenges going forward. And with the Single Resolution Fund now nearing its target and also the deadline for full resolvability in sight, can we be confident that all European banks are in fact resolvable and resilient? And what do you believe still needs to be done by the banks and also by the SRB? And I'll start right here, if I may, with Tuija Taus.
Okay. Thank you, Melinda. I start by saying that I'm very pleased to see the progress made by the banks to improve their resolvability. A lot of work has been done by the banks and the resolution authorities together to reach us to this point, very good point. Especially having sufficient MREL resources greatly improves the feasibility of resolution strategies. While there has been clear progress, we now need to continue and even accelerate the work we have been doing to reach the end 2023 deadline. Banks are having very huge work programs ahead of them, and what is needed now is continuous discussions between the banks and SRB and monitoring of the progress. And here I think that the role of the senior management of the banks is crucial because they are the ones who are able to prioritize these issues and put enough resources on the work. And for those banks that are lagging behind, I would say that using external expertise is one thing to consider. And as you know, I'm coming from a national resolution authority, having LSI planning in my remit also. And here I could say that it is very important and useful that we've been able to exercise the competencies and procedures and capabilities that SRB and bigger banks are using in their resolvability planning work, also with regard to the LSA planning. So it's needless to say that from the banking union perspective, it is important to ensure that also the small and medium-sized banks are resolvable. So I stop here.
Thank you very much.
Something for the others.
Thank you very much. And of course, that is a point that's been made several times that we want to drill deeper on. Let me go now to Jose Manuel Campa with the same question about resolvability and also resilience.
Thank you and good afternoon, everybody. And thank you again for inviting me to be here. It's really great. So I think, I fully agree that there's been a large amount of progress in terms of resolvability of banks and working on recovery and resolutions. A decade ago, there was nothing, basically, on this front. Nothing from the point of view of regulation, almost in many countries, nothing from the point of view of institutional build-up, and almost nothing from the point of view of the way banks thought about these issues. And now we have a lot. So that's really good. Having said that, I think that obviously we're not finished, and I don't think we will ever be finished. So I think this question will probably be on this kind of panels for the rest of our lives, because as the environment changes, we need to reassess how resolvable is the bank or an institution to the new environment, and as new things come into the table, I'm sure the assessment will be continuous, just like the prudential assessments done on a continuous basis. So I think that in that sense, the question will remain open. But think about the gaps that we have right now. If I were to highlight 4 gaps, the first one I think is, we need to be convinced that the banks are resolvable and that they themselves think about how they can be resolvable so that they can not just have the 500 pages famous plan or document that's on the table, but actually how you go from the 500 pages to implementing it. And, like doing war games or things of that sort, dry runs may be a good idea potentially to do that, But that's an area which we need to work. We just put forward at the EBA some guidelines on resolvability that will help in that direction, but that's one aspect. Another aspect that was mentioned a lot of times already is MREL has not been built up completely. So we need to continue to build that up there, or institutions need to continue to build that MREL to the extent that they can, and make sure that they are able to fulfill all those gaps. Third aspect, I'm trying to focus first on issues that are not to do with regulation, is the issue of potential gaps that we have on resolvability from liquidity and funding. This has been a discussion that's been with us for many years, and still a little bit open. What will happen, really, if the liquidity was needed there from the point of view of institutions? And then finally, the last one that I'd like to bring up is the issue of the change that we have already been discussing. We'll discuss later about the CMDI, the crisis management deposit insurance, and how do we do the assessments to make sure that we have adequate resources and the best strategy available for every bank at the time that actual resolution needs to take place. So let me stop here for now.
I will now try to go to Claudia Buch. We did get a brief glimpse of you, Claudia Buch, so I'm hoping that you can hear us. Could you just confirm?
Yes, I can hear you. Can you hear me?
Yes, we can. And now we can see you as well. So that's wonderful. Okay. I don't know if you did hear the question that I posed to everyone. Essentially, it was about your assessment of the degree to which banks now are resolvable and also resilient, and where you see important gaps and challenges.
Yeah, thank you very much. And let me apologize. First of all, I spent a lot of time this morning on trains trying to come to Brussels, and then I decided to go back to my office just to be on the safe side, at least participate virtually. Yeah, so I guess I agree with many others that I've heard that if anything, the glass is half full rather than half empty. So you very often hear people say, well, the whole resolution framework is extremely complicated, and how is it going to work in a crisis? And I think we've actually achieved a lot. So like others, I would like to congratulate Elke and the entire team for that. So obviously, I mean, a lot has been achieved, but what we know about how the resolution framework is working is quite indirect. So fortunately, we didn't have a major crisis over the past decade. So we have a lot of indirect evidence of how the system is working. And I think we've really come a long way in solving the too big to fail problem. But again, the system has not really been tested, and I think we all hope that it won't be tested. But I think we also all agree, and I also heard people saying that that making further progress and closing the gaps is really important because geopolitical risks have increased clearly. I think we're also at the beginning of a period of accelerated structural change that holds for the real economy, but also for the banking sector. And I think the willingness of policymakers to come forward to rescue failing institutions will be more limited, more constrained going forward. So I think we have to make sure that we do have a resilient system, and maybe we can even discuss more how macroprudential policy comes in here, because macroprudential policy really has the objective to act preventively and to strengthen resilience with regard to also macroeconomic risks. And I think when you read the recent SRB report on resolvability, and when you also look at what the FSB, the Financial Stability Board, found a couple of years ago in terms of where are the gaps in the resolution frameworks, I think the message, the common message is pretty much the same. So a lot has been achieved, but there's also many obstacles. There's still a few obstacles to resolution. There are issues about transparency and information. So when you read the SRB report, you also see that in terms of management information systems that can be improved, but also internationally, I think there's also some gaps we still have in terms of understanding how the bail-in instruments, how they're allocated across investors and so forth. So I think we really have to work on these gaps. But again, the positive news is there's also an agreement on where the gaps are, so then it becomes easier to close them. I think what would be useful and interesting for Europe is also to work more on empirical evidence on implicit funding subsidies that are still in the system. So one of the things we learned from the FSB evaluation is that implicit funding subsidies have declined, but they're still there. And I think they're a very useful indicator to assess how much progress we've made with resolution. So let me just mention a couple of things that I think could be part of the CMDI review and where gaps could be closed. One is that obviously we have more funding in resolution the earlier we intervene, but of course intervention shouldn't come too early so that valuable business models are not being put at risk. So intervening earlier more effectively, I think that's one element. We also have still some discretionary scope in the crisis management frameworks when it comes to also, that is something that others have mentioned, the choice between resolution and national insolvency proceedings. And I guess everybody working in this space knows that, yes, we have improved a lot in terms of cross-border coordination and communication, but there's also more we can do, in particular the interaction between macroprudential authorities and resolution authorities. Thanks, and look forward to the discussion.
Thank you very much, and thank you for enduring all that time in trains and nonetheless being with us this afternoon. I will now go over to Pedro Machado.
Thank you very much, Melinda. Well, drawing on your question, if you look at the resolvability report that was published by the SRB back sort of 2 months ago in July this year, you'll see that there has been substantial progress made in all the key dimensions that leads or that compose the sort of resolvability of banks. Of course, one of the major progresses that has been achieved links very much to a sort of foundational idea that led to the banking union, which was the idea of risk reduction. If you take the sort of strengthening of capital ratios, reduction of NPL, but then the steady build-up of MREL, in this case loss absorption capacity, you'll see that most banks under the remit of the SRB today comply already with the final target, the final binding target by the end of 23. And what is most striking, and I think it's also a very positive development, is that to comply with that final target, there was also a key stage of that, which was the intermediate binding target by the end of 22. By the end of 21, sorry, so the beginning of this year, that was met by the vast majority of the banks, which meant that many of the banks, and in particular those that had less track record in tapping the market, so the banks which business model relies basically on funding for equity and deposits, have been successful in tapping the market. So this is also a sort of a positive input from the push that was also made by the SRB for this steady build-up. So we have still a shortfall when it comes to loss absorption that is vis-à-vis the final target. But basically, if you look at the last 3 years, and I think Sebastiano mentioned this in his intervention, we basically halved the shortfall vis-à-vis the final target, including the CBR. I think this is a major development. But I think loss absorption is only one of the key dimensions of resolvability. There are also dimensions of resolvability which we have continue monitoring and which have assessed. And in that regard, and mindful that some of those are not yet phased in, so there is still some leeway in terms of time for banks to comply with. But we have seen maybe a sort of more unbalanced progress, in particular as regards issues that still need for further work of the banks, which is demonstration of certain of the capabilities in the field of management systems, both for the extraction of data for valuation, but also for bail-in execution, and in particular for liquidity in funding or liquidity in resolution. There, I think this is one of the areas that we will definitely will like to see more progress from the banks. Mindful that they have to rely on their capabilities to extract, forecast the funding needs post-resolution, and to identify unencumbered assets which they could mobilize rapidly to as means of collateral for filling the gaps in terms of liquidity. These are areas that clearly call for further work. But one issue that I've been listening with interest is the issue, of course, of finding that resolution plans are these long documents full of pages. And if the banks know this very well because they are now getting, and since last year they've been getting working priorities in terms of their work plans on resolvability. One of the issues that we are now focusing is on testing and dry run. It is crucial to understand whether the playbooks that are delivered by banks are really operational and whether they work. And this is something that I think, in particular in these last 2 years before the expectations for banks phased in, this is a crucial area of work. We have to understand really the extent or whether there are some entanglements regarding the playbooks that have been delivered. Also, we have to understand whether there are some obstacles coming from the legal orders where the banks operate. This is also crucial for us, and I think the dry runs or the testing will show, or should permit to identify those gaps. And coupled with this, basically remains the question, also there is an important question which is not, of course, common to all banks and in particular also only addresses a few banks, but is of the essence, which is cross-border recognition of bail-in clauses. This is something that we will clearly have to be sure that the enforceability of those cross-border recognition clause is a given. So I think we have still, as you might see, although I think the outlook of the resolvability report and the resolvability assessment that we have done against our new methodology on heat map has showed a meaningful and significant progress. I would say, just to summarize, that the issue on testing, dry runs, and liquidity in resolution remain areas of major attention, coupled, of course, with the careful monitoring that we'll have regarding that still existing shortfall to meet the final binding target. So this is clearly the areas that need constant work and, from our side, constant monitoring.
Thank you very much. And Tuija Taus, one of the points that you made about the disparity between larger banks and small and medium-sized banks is something that's been underlined by a number of speakers. And in fact, the recent resolvability assessment of the SRB does point out that the progress that's been made has been very much spearheaded by the larger banks, whereas smaller and medium ones do lag behind. So if we could drill a little bit deeper, what are the concrete risks that you see due to this, and what do you think is the best approach to setting the appropriate level of MREL for these institutions?
Let me start by saying that it's very important that also small and medium-sized banks are equally resolvable, as they play a very important role economically in the European banking sector. If we have a system-wide crisis, the risks can spread among institutions of all sizes. And we should not even forget that we can have a situation at hand where we have a situation where there is too many institutions to fail problem. So to be able to deal with any kind of crisis scenario, it's crucial to take care of the resolvability of the small and medium-sized banks too. And here it's important that the best practices that are used in the resolvability work for larger banks are equally applied also to the smaller entities, that at least relevant small and medium-sized entities become resolvable. For example, this year we have seen that crises may jump up very quickly, and they can be very new and unexpected situation where we need to be able to work. Then on the MREL, especially the requirement to obtain sufficient level of MREL capacity has often been criticized by the small and medium-sized banks of being too difficult and too costly. And it's a fair argument, but my experience from Finland shows that even the smaller banks have been able to meet their MREL requirements by issuing debt instruments. So, of course, I understand that situation vary, and there are different circumstances across institutions, but it is possible. Even so, we have to remember that in many cases, transfer strategies can be more suitable strategies for small and medium-sized banks than open bank bail-in strategies. And on this area, SRB is now working a lot, and I think that this route might entail adjustments of MREL targets, provided that these transfer strategies are feasible and credible. Thank you.
Thank you very much. And I'd like to stay with the focus on smaller and medium-sized banks and go back to Claudia Buch, if I may, to pick up on a point that we touched on this morning. Claudia, I guess you probably weren't able to follow those discussions, but we did speak in our last panel about deposit insurance and the CMDI framework. And the German banking sector, as we all know, includes numerous savings banks that do belong to an institutional protection scheme that is recognized by German law as a statutory deposit guarantee system. Ministers of Finance agreed in June that the reform of the CMDI framework would take due account of such national specificities, including by preserving a functioning framework for institutional protection schemes. So the question, quite simply, is this: whether it makes sense to leave such schemes out of the CMDI framework, or whether there are real risks associated with exempting what amounts to quite a large part of the German financial system when we take those banks all together.
Yeah, thanks a lot for this question, which is obviously very important for the German banking sector. And actually, I mean, I would I would agree with almost all Tuija said about small and mid-sized banks that shouldn't be excluded from the general rules we have in Europe. Also, that MREL instruments can be useful for this institution. So actually, my reading of the statement would be a little bit different. I mean, of course, we always know that national specificities is a placeholder for certain national interests, but for me, that wouldn't mean that we should exclude these banks from the principles that we have in Europe. And you basically mentioned the reason why, which is that actually the German savings banks, and it's also the cooperative and mutual banks, are relatively large compared to the German banking system. And then because Germany is a relatively large country, they're also important for Europe as a whole. So we should make sure that we don't introduce competitive distortions for banks that in fact make up for a relatively large share of the German banking system and the European banking system. And as has been said rightly, also smaller banks can be too connected and too many to fail. So let me just say a word on how this is traditionally organized in Germany, and also how we look at the institutional protection scheme. So they're basically about mutual support for their members. Now, they are organized slightly differently. If you look at the structure, the cooperative sector is more centralized, and actually there have been many also mergers of smaller cooperative banks and also savings banks with others, so that there has been an active restructuring of the sector. But yeah, admittedly for the smaller institutions, so the savings banks are a bit more less centrally organized. And there's been in the institutional protection scheme, this has elements of deposit and guarantee schemes and going concern support, and now the cooperatives actually split these two systems, and the savings banks are working on this. So splitting the IPS support institutional protection scheme from the DGS function. So as I said, we've looked into the governance mechanisms of these schemes, and we've also made proposals of how to improve them. And I think there's one interesting element talking about MREL, namely the fact that actually a lot of MREL is held within the German banking sector. So this is also due to the special structure of the system, but it also has to do with zero risk weights attached to these liabilities if they're held within an IPS, and also some special treatment when it comes to the deductibility from own MREL. So I think this is something we might want to reconsider. This is one of the elements, as I've said, where we need to make sure that we apply the same rules, and that we have we look at the incentives within the system, because for financial stability, it's obviously better if the bail-inable funds are not held within the sector. We would rather have them outside of the sector, so that there's effective risk sharing. Thank you.
Thank you very much for that. Let me go now to Jose Manuel Campa, if I may, to talk a little bit about transparency and resolution, because this is something for which the EBA has long advocated. And the SRB has taken a step in this direction with its resolvability assessment of banks at aggregate level. The Bank of England, the US, Switzerland, and some other jurisdictions have issued comprehensive reports that include data on specific firms. What do you think is the right balance when it comes to transparency and resolution? Should the EU publish more individual bank data, or do you see risks in doing that?
Thanks for the question, because as you say, the EBA has, since its inception, been very keen on transparency, and I think that we've done a good service over the last decade, to the banking sector and to stakeholders by pushing very much, standardizations on the way the banks report information, the more information being reported. I think that's been good progress, and still more to come probably going forward. So in the area of resolution, we also think that transparency will be important and helpful, and we welcome very much the report from the SRB. I think it's a good step forward, and we're engaging with them and with our authorities to try to assess towards them some level of bank-specific transparency, which I think will be helpful as well. Should be done, and what are the bases that should confirm that transparency. It has a number of components. One part is that there should be also probably more regulatory guidance in terms of what kind of transparency should be provided to the market, which right now there isn't, and probably the process of the CMDI will probably maybe see some progress there. But beyond that, we need to discuss about what are the objectives, and also what are the objectives that we try to pursue, what are the kind of information that can be provided to the markets that could be useful to markets and could be useful to institutions. So, just to give you a general guidance, I'll give you two areas in which I think that the more transparency will be helpful. One area is, for instance, on the area more clarity on what's the preferred resolution strategy of an institution, particularly now that we're reaching 2024 when MREL requirements will be binding and we have clarity on whether they fulfill them or not. Well, how is that MREL going to be used, and why is that the overall assessment? I mean, it's a preferred resolution strategy. It's not necessarily exposed the definite resolution strategy, but I think that would be helpful to stakeholders to understand the amount of MREL. Another area in which I think that will be helpful, and probably maybe for a little bit of a different reason, it's on resolvability issues, and resolvability impediments and challenges. I just said before in my previous intervention that banks need to improve in that area. I think that we ask them to report and to be transparent about what they're doing, it will certainly focus more the eyes of senior management on those topics, and probably will help them push that forward, because they'll be much more aware that there is obviously more transparency on how well prepared they are for solid. So those are two areas in which I think we can probably push forward.
Thank you very much, and let me go to Pedro to comment on that if you like, Pedro, but also maybe to talk a little bit more about some of the work that the SRB is prioritizing now around several issues that have been mentioned, transfer tools, adjustments to MREL for such transfer tools, and what are the challenges in the current legal framework that we have to proceeding with that?
Thank you for that question. I think it's at least you have the opportunity also to develop a bit on the sort of work that we have been doing on the part of the transfer strategies, which is, if you look roughly, this is also displayed in the report, 80% of the banks have, and our remit have as preferred resolution strategy, the bail-in, whereas 20% have transfer strategy. This does not invalidate that some of those banks might also, the others that have bail-in as a variant, also some kind of transfer strategy foreseen, as it was the case, for instance, of Sberbank. Why is it important to now shift a bit the focus, or why we have been dealing now a bit more concentrated with transfer tools? Well, basically because the SRB does not have unlimited resources, and it had to prioritize the work on bail-in operationalization. The largest chunk of the banks that have, as I said, preferred resolution strategy being bail-in, and as such, much of the work had to be concentrated there, and this is translated now not on the set of policies, but also on a set of guidance that will frame also now this work, this more concrete work that we expect from banks, both on testing and dry run. But it is true that we were a bit, until 20, had not invested as much because of limited resources in terms of all the operational materials that are needed for carrying forward one of the tools that are akin to a transfer strategy, be it a sale of business, be it coupled or not eventually with an asset separation tool, be it ultimately the bridge tool, the bridge institution, which might be an ultimate ratio kind of solution if there is no viable purchaser in the resolution weekend. So the main issue we took a stance as if we would be what is needed if you want to carry forward this transaction on successful terms. The way we approach was to basically build on a set of operational documents that form an array now of different what we call operational manuals that will provide at least a basis for both the transactional documentation that you would be needing, and this covers a whole array of documents that would most likely be needed, as also the due diligence part. And the due diligence part is one that is quite important on the resolution weekend to perform the transaction. as it basically from that some of the decisions or some fundamental decisions might be taken by prospective buyers. For this to set up a virtual data room is of the essence, because this will then lead to shape or conform the sort of strategy according to the concrete market appetite, and as also the concrete sort of terms that the buyer might or not require, the sort of assets that the buyer might or not be interested, and in that regard also having enforced carve-out strategies is paramount. This is a work that we have been, I think we have been doing it in some sort of a very short time span for the work it entails, so that I have to fully praise the teams inside the SRB for having accomplished the deliverables in such a short time frame. And I think this is one of the essence, one of the key elements is that we are operational ready for doing this, that we can speak this, at least have the ambition of speaking the same language as the prospective investor would speak to carry forward the sale of business or the asset deal as it might be, or ultimately this is also part of the project to set up the bridge institution. So this is something that we have been, as I said, focusing very much. I firmly believe, and we firmly believe, that transfer strategies might offer a very viable option in terms of the resolution for a failing bank, of course depending on the business model, of the size, but in particular if carried adequately forward, they might provide an adequate basis not only to sort of be successful on the resolution scheme, but in particular also to ensure an orderly exit from market. I think we are all the key concern here is that transfer strategies also serve that purpose, that we somehow are able to address problems of viability of certain banks through those orderly exit of markets. And so we really consider. Just to finalize on this, of course, the fundamental question is always in this regard funding. It is true that the concrete terms of a transaction and one of the sale of business or an asset deal will depend very much on also the loss absorption part of the bank to ensure for funding. But it is also true, and I hope that with the CDMI review, a sort of issue that might also be key is this looking a bit more in the absence of ADs, that national DGSs might eventually bridge the gap that misses towards access to the SRF, in particular to attain the 8% TILOF. We really look forward for the proposals that might come up from the Commission. We saw Sean Berrigan this morning mentioned this. So this might also be a sort of a very fundamental feature to ensure that transfer strategies work out.
Thank you very much. That was also a proposal mentioned by Megan Green in her remarks earlier today. Let me now ask all of you to talk a little bit more about funding, but let's keep the answers very, very tight, if you would, please, so that we can hopefully just work in a couple of audience questions before we need to close the panel. So Claudia Buch, if I may come to you first. I'd like to know how you evaluate the progress that's been made on funding, including for small and medium-sized institutions, and whether you think that the current framework, including access to industry-based funds, should be reviewed, and how that would affect the role of the central banks. And all that in a very short answer, if you would.
Yes, I try. So first of all, I mean, that's an easy answer. So central banks can't really provide funding and resolution unless there's a bank that's after the resolution weekend that's fully solvent without any question. But in all likelihood, I mean, there will be a lot of uncertainty still on day one. So I think we need other sources. There's, of course, the discretionary component, the emergency liquidity assistance. But I think, I mean, to really cover losses or to recapitalize banks, if that's what we're talking about, I mean, this is for, it's not for the central banks, and is also not where we want to have taxpayers' money. So this has to be bail-in, debt loss absorption capacity and industry funds. So In that sense, I sometimes don't quite understand. Of course, it's understandable from the private perspective that the banks are saying they don't want to contribute to the Single Resolution Fund, but I think for all of us, for the public interest, so to say, I think it's good that we have the Single Resolution Fund. We need sufficient bail-inable debt, and as we've said earlier, banks are on track of reaching the TLAC. We haven't talked much about TLAC, but the TLAC and MREL targets. Now, clearly more needs to be done when it comes to the small and mid-sized banks. Like we've said earlier, they also have to be part of this regime. And I'm quite optimistic that also there the market could develop for bail-inable funds. Of course, we also have to consider other options and to what extent the DGS funds can be used. But I think it's important not to leave them out of the picture. I think we always, with all the solutions that are currently being discussed, we need to make sure that they instill market discipline into the system. So this is something that always has to be borne in mind, and that also everything we do is risk-based. And that's, again, where it comes to the contributions to the Single Resolution Fund. They're calibrated in a risk-based manner, and that's important.
Thank you very much. And let me pick straight up on the point about DGS and the link to funding. Jose Manuel Campa, do you think that DGS schemes should support early intervention and or alternative measures for banks in resolution if that leads to lower costs? And what is the best approach to defining the least cost standard?
Yeah, I think that I've heard this already a number of times today, and I think there's consensus on this. Let's see if we can go forward. The DGS it's already an option under kind of the BRRD, that they can be used for alternatives other than just paying out deposits, but it's very seldom used. It's very seldom used right now, and my understanding is of the last 5 years, it's mainly, I think, one member state, Italy, that has been using DGS in that form. Going forward, I think it would be desirable to try to do that. I think clearly it would be desirable. I think it's important there for me to be quick, just two simple, not too simple, two straight points. One is you need to have a more standardized insolvency procedures across the union, across the different member countries for banks. So as a result of that, you can also try to narrow down what is the definition of the least cost and how do you calculate that and what's included or not in that definition of the least cost. Because if not, the understanding of what could be included on that least cost varies a lot. As a result of that, the situation in which the DGS could be used will vary a lot across member states. So I said work on the common insolvency and a very narrow definition or unique definition of what's the least cost.
And let me take the same topic over to Taos, and ask you to talk about the interaction between the SRF, which, as we know, will be operating at European level with a 66 billion sum when it reaches its target, and the 21 national deposit guarantee schemes. Would you advocate pooling these resources, as has been mentioned a couple of times, into one single fund, and how would that link up with a potential EDIS? Again, briefly, if you would.
Okay, thanks for this question. I would start by saying that pure technical combination of the DGS funds and the Single Resolution Fund would not bring any major benefits. So this kind of a combination of funds would make sense only if the conditions for the use of the funds is harmonized and the decision-making power on their use is centralized. So in the longer-term scenario, in the EDIS world, I would advocate for pooling the EDIS funds and the Single Resolution Funds monies. But now, in the shorter term, and as part of the crisis management and deposit insurance review, I think this question is a little bit different. And I think that here the most important thing is to ensure that we have a consistent application of the transfer tools like measures, which we currently now find both in the deposit guarantee framework and in the resolution framework. And it is my thinking that the decision-making power related to these transfer tool-like measures should be only in the resolution authorities. And if we go this route, that would mean that we would have more banks with resolution strategies. And then the arrangements of the single resolution funds are more crucial, and the need for DGS funds declines. So in this scenario, there would not be a full merger of the DGS funds and the single resolution funds, as the national DGS funds would take care of the payouts for the smaller banks. And a first step to this direction is to ensure that the DGS funds can be used more efficiently in resolution. And the first panel was discussing about the ways how to do this. And with respect to your question on EDIS, my take is that the need for EDIS declines in case the number of banks for which the resolution strategy is the primary strategy grows, and that makes the arrangements for the single resolution fund more relevant. Thank you.
Thank you very much. And let me close with a firepower question for Pedro, if I may. So let's do some math. Let's add to the 1% covered deposit target for the SRF, the DGS 0.8% of covered deposits, and the future ESM backstop with its cap of euro 68 billion. If we add all that together, is there enough firepower in the European Union to avert a systemic crisis? The bottom line.
That's a very blunt question, but this all depends on the, I think, replying bluntly, depends on the size of the animal. So basically, it might be sufficient, but when I think your question is specifically regarding can be funding, but also in the terms of liquidity. Liquidity provision might not be sufficient depending on the size of the animal. That's why I think the SRB has been consistently advocating for a more sort of, and we are not denying, by the way, just to be clear, we are not denying the major effort and the contribution that the backstop by sort of doubling the available firepower will bring. That is not the question. Of course, this is a very positive development. The real issue is that it might not be needed in face of certain banks. And of course, we have been advocating for some more kind of structural solution, as I was saying, either linked to a sort of Eurosystem resolution dedicated facility in the post-resolution, which means after a bank has been undergone resolution and is solvent, and as such could be qualifying as eligible counterparty for monetary policy. And then boiling to the question that this, of course, would require adequate collateral. This is an unsurmountable requirement under the Eurosystem monetary policy treaty, requirements under the treaty, which means that in that case you might be looking for some sort of EU guarantees that would back the provision of liquidity. See, these are not easy questions. They basically stalled in November 20. There is this expectation that they should be resumed at a certain point in time. But clearly, this is something that, in particular, for possible liquidity gaps where the current backstops would not be sufficient is really of the essence. Just one final note on the question of the DGS eventually covering or complementing the firepower of the SRF. I think we have to be mindful that we are talking still about an SRF, a single backstop, coupled with 21 national DGS. It's not really like, although the amount in aggregate terms would be close to the US, we would still missing this piece of having a single backstop, which means that the over-reliance on the national DGS, and I fully agree with what has been said in terms of the harmonization of the least cost principle or the removal of the super priority, should also be seen as an intermediary step to the EDs. Because one thing, if we are over-reliant on the DGS and everybody becomes sort of confident and lenient with this status, this means that we are going to renationalize at least one of the parts of the banking union. This should not deter for continue to take and strive for EDs. Thank you.
Thank you very much. I think we can manage about 2 audience questions still. So if you have a question, please quickly put your hand up. One over here, one in the middle. Okay, let's take that one first. Please do remind us who you are, and if you would keep your question short, that would be great.
Thank you. My name is Boudewijn Berger, working with ABN AMRO Bank. Next year is an important year. We should all be resolvable by the end of the year. What will this finish look like? I don't expect the SRB to hand out medals, but could we expect a letter saying, yes, you are resolvable, or no, you're not resolvable? And if you're not resolvable, would that immediately then initiate substantive impediment procedures? Or will it something be like on a scale of 1 to 10, you're there?
Thank you. I'll just take the other question as well before we get some answers. Go ahead, please.
Hi, my name is Dave Vreugde, and I work for a Belgian financial institution called Argenta.
I think your microphone is not on. Could you try again?
Do you hear me now? All right, my name is Dave Vreugde. I work for a financial institution in Belgium called Argenta. And, well, I've noted a question. So looking ahead of the review of the crisis management and deposit insurance framework, I have 2 questions. First of all, is that if more banks are to be resolved, would you expect that more money is needed in the SRF? And secondly, do you think it's still suitable to let banks further contribute to the fund as they need to increase profitability and support the economy and families during this energy crisis?
Thank you very much. So let's get some answers to those. Maybe Jose Manuel Campa, would you like to get us started?
Well, I left the SRB questions for them or for Pedro, but I think on the issue of whether if we resolve more banks, will they need more money to the SRF? The evidence so far is that banks have been resolved without using the SRF, right? I mean, we have MREL, we have many other things that have been built up. So I would not link the 2 things. I would not link necessarily the number of banks that are being resolved with the use of the funds. The fund is there to be used if a bank, while being resolved, needs to additional money. But the evidence so far has been that these banks have been resolved without the use of the SRF.
Thank you very much. And let me ask Tuya to weigh in on whatever points you wish to make.
I could complement the answer by Jose Manuel Campa by saying that if there would be more banks with a resolution strategy, it doesn't directly affect the need to contribute to the Single Resolution Fund, because also currently all European banks or Eurozone banks are paying contributions to the Single Resolution Funds. Also those banks which have a bankruptcy strategy. So this doesn't directly mean anything to the contributions. And you had the question about the final size of the resolution fund and whether there is always a need to contribute more and more. We heard today that there is a political discussion, of course, going on also about this issue, but currently the size is relative to the amount of covered deposits. And the covered deposits have been growing the last few years now, and that's one basic reason why the fund is growing so much. And we don't know what is happening during next years.
Thank you very much. And then over to you, Pedro. There was a question about whether you've already started writing those letters that will include gold stars, I guess, for some. And
Thank you. No, we have actually started writing the letters. They are almost finished on the working priorities for 23. So you're going to be getting those. And those are the sort of path, or they consolidate the path that we expect banks to comply with, so that next year they are going to be fully compliant. Listen, you know that from our experience, and that the dialogue in particular is very constructive at the level of the teams, and the banks know very well what they need to do to become fully resolvable by the end of next year. And of course, you'll be going to be the first one to know whether we are pleased or unsatisfied with the progress that has been achieved. This said, of course, we have now the report also that in aggregate terms measures the progress to resolvability. This is also going to become some sort of, is a transparent way of the SRB pointing out what needs to be done. And of course, we don't expect to have to trigger the more draconian measure that exists under the legislation for the case of non-compliance. We think that with constructive dialogue and the appropriate feedback, that full resolvability is going to be attained, and we remain confident on that path. So we have a much more sort of positive still kind of mood, and operating on the kind of mood too, and considering that there are the conditions to meet the resolvability, full resolvability by end of next year, then immediately wanting to jump into some kind of draconian measures after 23. Thank you.
thank you very much, Pedro Machado. Thank you very much to all of our panelists, including Claudia Buch, whom we can't see right now, but I hope that you can still hear us, Claudia Buch. Many, many interesting insights that you have all shared with us, so we're deeply appreciative of that. Let's give them a very warm round of applause. And dear ladies and gentlemen, many thanks to you as well for sharing your contributions and for your attention during this very intensive day. It is now my pleasure to hand over for some closing reflections to the SRB board member, Bastian Yazbek, and I will come back just after that to say a few words on how the press can then attend the press conference that we'll have directly after.
Thank you. Thank you, Melinda, and thank you all for being here today with us at this very interesting conference. Of course, it's my pleasure to give you the closing remarks, and I want to be really brief and just share with you two takeaways for you to ponder as you leave in the next couple of minutes. So the first such thought of that has been greatly shared in the first panel was on the state of the crisis framework. Is it really good enough? And the speakers and everything said on the first panel show that that path that we have come across in Europe in terms of building such a crisis management. Not only we were unprepared in financial crisis of 2008, we have to be honest and also say that we didn't really know what was going on inside the major European banks. We didn't have a proper oversight, we didn't have European supervisor, we didn't have banking resolution system. So today, if it's true that some elements of the banking union regulatory framework are still missing, as we heard, at least we have a framework within which we can monitor progress and identify gaps. We can also measure our progress, and we can at least be aware of the shortcomings there. Also, we know much more about the shape of the banks compared to everything that was unknown about them in 2008. That is surely something that we can and can play a positive role in the overcoming of the upcoming, hopefully not too many challenges. Also, at the end, everything results and then relies on the knowledge and experience of the people who work at the institutions in charge of the supervisory and resolution framework. Because at the end of the day, institutions are nothing but people who work there and people who govern them. This brings me to the second takeaway. Can we really say that European banks are resolvable and resilient today? Well, there are many thoughts and views on this point, as heard in the second panel, but I think we can say that most banks by now are resolvable, at least on the paper. Even though we have detailed plans for each bank, there is always room for improvement. The larger the institution, the more complex the arrangements. So focusing on how the implementable each resolution plan actually in reality is going to be the center stage from here on. So no longer there is enough to have a resolution plan in place for each SRB bank. Our focus should shift to make sure that the plans on the paper can work in practice. So testing and fine-tuning existing plans to ensure our banks are resolvable with the least possible damage is, for me, a key challenge in our work in the months and years ahead. In fact, in order to fine-tune our banks and our plans, the SRB might adopt the test, track, and trace approach. Our testing should continue with individual resolution plans, while tracking and tracing will be collated in the resolvability assessment and heat maps to be published, and of course, new guidelines to be drafted. But we should avoid falling in the trap of being overprescribed and undermanaged, as it appears that resolution is sometimes more an art than a science. That said, brings me to the end, and of course, a few words of thanks. Thank you to all of those that brought this event today together. Thank you all the speakers, and thank you all the audience that after years of being confined to the WebEx and Zoom are here today in Brussels with us, and of course also those who are still online. Last but not least, thank you, Chair, for all the work being done. And as this is probably one of the last public opportunity, also to wish you all the best with your future endeavors, whatever they are. Thank you, and all the best. Thank you.
Thank you very much, Bastian Yazbek. And dear colleagues, if you are from the media, you can immediately, after I close this microphone, come down to the front of the room. Elke König will then take your questions here in the front, and I welcome you to join us shortly. I just want to also say thank you to all of our organizing team for their amazing work, as always, flawless and very collegial and professional. And also, many thanks, dear Elke König, for your service. It's been a great honor to work with you. And that ends the SRB Annual Conference 2022. I wish everybody safe homeward journeys. I hope that our paths cross again soon. Goodbye.